clearly the consumer in these earnings is holding up better than expected, somewhat confirming that better retail sales that we got in September. The consumer balance sheet still is healthy, even though at the margins it's deteriorating. Eventually, you will have to refinance at these much higher rates, and that's the reality of higher for longer starting to bite.
And we'll be doing a poll later. Do you want Tom Keene or Cameron Dawson on air with you in the morning? Let's do that poll.
Okay. Yeah. How are those? You know, I've got to go back to vet bill. Did you really put a vet bill on Ozempic?
Yeah, we did. We did. It's a testing.
Vet control and to make sure that vet bill gets fed.
Mrs. Keene has a medical history, and she says, we're not even trying it on you. We're going to the dogs first to do it. And,
I mean, pet Ozempic is on the way,
yeah,
right? That has to be the next stage.
Oh, come on. It's true, you know. Pet Lexapro is really hot.
We're not kidding, folks. Katie's dead on there as well. We'll have much more on that on the pharmaceutical front. Red and green on the screen here. Dow up actually fractionally. I don't know what to make of it. I got to get my percentage thing. Let me move the gerbil here over. We're down 0.3% on the S&P 500, 19.17 on the VIX. The yield space, help me here. We had Bill Ackman came out. Bless the world, the bond market stopped, and it was price up, yield down. Is it over?
Okay, first of all, anyone who says that Bill Ackman's tweet saying that he closed out of a short position was the reason why we've seen volatility in the 10-year is fooling themselves, okay, number one. And honestly, come on, am I wrong? And it's ridiculous.
All I have is the lines, but I will say if he actually opened the short when he tweeted it, and if he actually closed it when he tweeted it, I mean, worked out pretty well.
He did really well, but I will just say there was a lot behind it, and there's a feeling that maybe he was picking up on some technical closing out of shorts that were pretty global in nature.
That's the thing.
At a certain point, right? It's not just him. He might be feeling the tea leaves in the market and kind of,
he's probably watching surveillance is what he's doing.
Well, come on, and you can explain. Do you think that you are responsible for this move?
We're going to dive into this right now, and it was really shock and awe here. Just on a personal note, I've got computer people in my family, and you get the call, you got a beverage in your hand, and these people are way smarter than me, trust me. They got the A's. And they're like, hey, stupid, ChatGPT is the real thing. And we learned that yesterday at 4 p.m.
Moody's says it's going to start writing their work. Did you see that?
I'm the ignoramus here. Mandeep Singh is a smart guy, senior technical analyst in Bloomberg Intelligence. What'd you learn from Mr. Nadella yesterday? This was the mother of all home run reports.
Yeah, I mean, the Azure acceleration, I think they sort of sandbagged expectations because last quarter it was like 1% contribution from AI-related stuff. This quarter it was 3%. And the expectation is it's going to keep growing. But everyone knows that they are looking to deploy their large language models, train their LLMs. Right. And look, this is a secular trend. This
Tyler Radke at Citigroup published, I believe it was this morning, maybe late last night, and he just basically said, you know, this is like a complete report. Define what Copilot is.
Yeah, so right now they have a GitHub Copilot, which basically allows developers to be more productive because it writes...
For a fee.
For a fee, and they're charging $10, and they have about 10 million, you know, people signed up. So it's already a pretty sizable revenue
stream. That's like your newsletter. Think about that.
Right, well,
$10? Wow. You got 10 million people on it.
All right, so they can, you know, you can hire ChatGPT to fill a seat, which I think will be a beautiful thing one day. But this raises this question, and I'm going to steal some of Katie's thunder because she had a really good point earlier. This idea of, have we overplayed AI and not emphasized the cloud enough? Was the real surprise for Microsoft really just purely the cloud, and the AI discussion not really there? And the same story, except the reverse kind of sentiment for Google.
I mean, look at how much these companies are investing in CapEx to build their infrastructure. So clearly there is a huge upfront investment. And in terms of the monetization, Copilot is one form. Then renting your cloud infrastructure is the second big form. And they are launching a big 365 Copilot starting November 1st. So that could add to the revenue in addition to what we heard about GitHub. And look, at the end of the day, cloud training is where the money is because that's where the GPUs lie. I mean, everyone knows NVIDIA had a big lift because of the GPU demand. Well, guess what? Who are buying these GPUs? It's the hyperscalers, and then they are renting it out.
The big fear right now is that Google's gap its lag behind the cloud competitors is only growing. Do you see this as evidence of that?
I think Google, again, is more niche-y in the sense that they don't have a legacy in enterprise business as Microsoft does. So clearly they have to build it from scratch. And they're focusing more on the AI side of things, rightfully so. And in this case, some of the deals are lumpy, so I wouldn't make a lot out of the miss last night. I know everyone focused on the 2 percentage point miss. But look, they're building this from scratch, and it's at a very healthy $32 billion run rate, growing at over 20-25%. And to my mind, it's going to accelerate because they are one of the biggest buyers of GPUs as well. So where would you rent the GPU capacity besides Microsoft and Amazon? It's Google.
Mandeep, I also want to talk a little bit about search because this line from Microsoft's earnings caught my eyes, that you take a look at Bing's search and news advertising sales increasing 10% in the quarter. So it seems a little bit like advertising spend has stabilized. But when it comes to Bing versus Google, does Bing have any hope of taking serious market share from Google?
Well, I think Satya Nadella walked back his comments, during the testimony that he was aiming for share, but he conceded it's very hard to take share from Google. And Google's results last night showed that at a $180 billion run rate, if you're growing double digits, that just goes to show how much power you have. Whereas Snapchat grew 5%. It's much smaller. And I think you get to see where the ad pricing power lies in the ecosystem.
Did Greifeld get the memo that we're Bing free? We don't talk about Bing here.
We talk about Bing all the time.
Well, I lasted almost an hour.
Pick it up, Katie. See if you can do better
Okay,
in the
well,
next
let's
5
see.
minutes.
Are we allowed to talk about Snapchat? I don't know. Well, let's talk about Snap.
They make great tools. They're out of Ohio, and I love their socket wrench.
They have
Continue.
my AI. Okay, let's talk about Snapchat because they came out with earnings. The shares spiked 15% after hours. Now you take a look at shares. They're actually, I don't know, down slightly. What were we so psyched about at around 4 p.m. yesterday that we're not excited about at, 6:53 in the morning?
I mean, clearly the top line print was better than expected, but when it comes to the guidance, the EBITDA number is the key for a company like Snapchat because they keep losing money. So because they had a positive EBITDA quarter, everyone thought it's going to continue, but in their guide, they were quite vague about where the leverage is going to come from, and it was just too uncertain to figure out whether this is sustainable or not.
But it goes to this question, this larger question of how the market is measuring the performance, the response. And you talked about how you actually disagree with the response to the Google Google earnings, that you think people are overplaying the slight miss and they're underplaying the potential for AI. Does that mean that right now, just from a market perspective, any results that show you the money are the ones that are going to be rewarded, not the ones that show you hope, which is what some people were really trading on with the AI promises of yore?
Yeah, I mean, results matter, and in Google's case, there was an operating income miss as well, but they are investing. And with Google, I see, YouTube being a very big business. In fact, YouTube subscription growth has accelerated past all the streaming players. So the live NFL content is working. Cloud is another driver. Search remains robust. So the durability of earnings is there with a name like Google. Yes, they may have a bad, a slight miss when it comes to operating margin, but it doesn't change the fact that they've got all these large businesses with a long runway. And I think that's the thing to focus on.
Can you extrapolate out to Apple here? I believe it's November 2nd, whatever day that is. If we saw Microsoft do what they do, are we going to get the same joy, the same completeness as Tyler Radke talks about? Are we going to get that from Apple?
Very unlikely, given what's going on with China and their focus on moving the supply chain. And look, they're a hardware company, so we know PC and smartphone markets are still bottoming out, so they will not have a big quarter. And the one risk factor for Alphabet, going back to that, is if Apple decides to do their own large language model on the phone and take out the distribution they have for Google, which has come under scrutiny, that's a big risk for Google search. I mean, other than that, I don't see any risk for the business. But if Apple decides to do their search and maps and everything, large language model, that's a big risk.
Mandeep, thank you so much. I got 8 more questions. Mandeep Singh with us. We'll have him on here over this arc of these tech earnings as well. Lisa, I just was flabbergasted at the completeness of the Microsoft. Usually there's one dog division. There's something that...
Sandbag was
Hermes had silk scarves, didn't move. Somebody, the cognac LVMH, the cognac didn't move.
Right, exactly. When at Microsoft, everything moved. The sandbagging, I like that. And basically, they just sort of quietly come up, like, boom.
That's the street experience of Mandeep Singh. Let's talk down earnings so we look good. I'm shocked. Red and green on the screen. The VIX 19.17. Must watch. Katie Kaminsky next.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, is the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
This is a transitional period. Transitions aren't easy.
The bear steepening that we've seen in the curve over the past several weeks and months has really driven everything.
Eventually, you will have to refinance at these much higher rates, and that's the reality of higher for longer starting to bite.
Markets have started to price in these different expectations for bond markets.
Okay. Investors are looking for any glimmer of hope to start a end-of-year rally.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, worldwide. Farrow, sabbatical or sojourn or something like that. We'll get a report from John Farrow here at some point. Katie Greifeld, the short straw this morning, joining us here with all these different narratives on. And I'm just going to cut to the chase for Global Wall Street. must listen. Katie Kaminsky with us in about 4 minutes. This is on trend-based technical analysis, and her note is blistering on the risks that are out there. Lisa, what's the chief risk this morning?
Well, the chief risk right now is earnings, and that's what I think we're seeing, is that specific stock by stock will set a narrative for the specific stock, and you're getting divergent stories within the tech space. The fact that we're talking about that is wonderful after being whipsawed by the 10-year for about 3 months, and everybody was just talking about the 10-year yield. So I'm trying to shift to something else and hoping that maybe these other stories will come to the fore a little bit more.
What's the hope in the bond market? Tell me what you've seen in the credit space you're expert on, because we had price down, yield up, and we've had a little recovery, and I would editorialize under no technical veracity at all. We're just in a nowhere land.
At this point, people are looking for stability more than yields coming down. That will be enough to generate some sort of feeling of comfort. Even if yields level out at this level, it will be okay as long as things are stable. The instability is what left people very concerned, because it creates a whole host of existential questions about whether the bid is walking away.
The existential question, folks, is a 10 a.m. meeting this morning. The real yield, look for that on Friday. Let's get a pre-brief here. Katie Greifeld. You know, I look at where the inflation-adjusted yield is right now. It speaks volumes. What's it say to you?
I mean, you look at the 10-year real yield right now. We're clocking in at 2.44%. We're talking about the highest levels in more than a decade. And I think to Lisa's point, I mean, for the past few months, really, it's been both rate of change and the level that's been shocking. Maybe if we can get rate of change to calm down a little bit, we can actually digest the level. But the levels are pretty amazing as well.
Calculus with Greifeld this early in the morning.
Well, I mean, the market has been hinged to calculus because they don't know what other mooring to really go to.
You should see Calculus 101 at Haverford. It is unbelievable that they're all half asleep. Everybody's wearing Birkenstocks.
I did not do well in Calc 101.
You didn't do Newtonian calculus at Haverford
I was in baby calc.
A baby calc, okay. Well, there's where we are. We're going to do a morning brief here. First on the date, I really want to emphasize it is that no man's land, if you will. The 10-year yield, 4.86%, 30-year bond under 5, 4.98%. As Katie mentioned, and she knows this is what I'm glued to, you're up 2 basis points on the real yield. This affects everyone in America, 2.44%. Lisa, you were talking about Torsten Slack, 10%. Small business loan expense, which is just basically unthinkable.
The small businesses are getting hammered by this more than most, which has raised a real question for the central bankers who are hearing from those small businesses and hearing about that pain and keeping rates where they are and potentially raising them even further. 10 a.m. we get the Bank of Canada rate decision, and the expectation is to hold rates at around 5%, but with a hawkish tone. This is the new kind of expectation from central banks. Tomorrow is the ECB. 1 p.m. Katie, to your point, I am watching this closely. Every single auction is incredibly important. The U.S. Treasury is planning to sell $52 billion of 5-year notes. This is where the real uncertainty has come from, the fiscal overhang.
Yeah, I mean, if you think about that 30-year auction we got, 2 weeks ago, it was so sloppy, a tale of 3.7 basis points or something like that. Be interesting to see if the short end is any better received, but those auctions are definitely top of mind.
The technicality of that is something we're going to be speaking about with Katie in just a minute. And today, after the bell, we get Meta and IBM. Meta and IBM sort of show the two tales of the loved and the unloved in the tech space. Facebook, parent company at least, 160% gain so far this year. IBM lower by 2.2%. How much is this trading on a hope, and how much is this trading on true fundamental strength that could be representative of economic momentum?
I got to admit, I mean, Farrell picked this. I did not see this coming. My basic idea is IBM the one that should have changed its name?
International Business Machine?
Very good. The genealogy clicks
I Googled everything on the rundown.
Okay, welcome to my act. Katie Greifeld giving us grief this morning. Farrell would never do that. This is right now, for Global Wall Street, the interview of the day. Everybody's fundamental base. Katie Kaminsky is weaned on the technical analysis of trend, going back to the giant Wells Wilder of 1978. She's with Alpha Simplex. Katie, an opening question. What's a trend right now in equities?
So equities right now, we finally see some of our signals tick short net, which kind of is surprising to me. And second of all, the biggest trade and biggest thing to follow, and this goes with what Lisa's saying, divergence. We've seen long signals in big tech, mega cap, and we're seeing short signals in the small cap. That tells the consumer the average stock is in trouble. Your big high names, they're doing well, but your average stock is worried about higher rates.
Katie Kaminsky and I studied Tushar Shande on beta. I'm not a big believer in beta for those of you from Global Wall Street. Katie, in this world, do you have to do beta as a sector study or index study, or can you actually have the conceit and confidence to do beta on individual securities?
So we tend to think about looking at sectors because we're trading more in the futures markets, but we do also look at some of cash equity strategies as well. And we're definitely seeing tilts right now. You're seeing people talking a lot more about tilts to defensive, tilts towards oil companies. So right now, I think this divergence trade is about finding certain areas of the market that are going to do better or worse in a higher rate environment. But it is tricky because it's uncharted water. We haven't really figured out what's going to happen next. That's pretty much the theme we're thinking and seeing, is that we got to the higher rates. What's next? Which stocks are going to succeed? Which are going to be able to refinance? Which are going to waver through this new environment?
Katie, I was so excited to speak with you today because you follow trends, and I'm looking for a trend in the 10-year yield. And yeah, it's up, but it's also, you know, we've been talking about a ping pong ball. Pick your metaphor. How can you find a trend in a market that's unanchored?
Good question. I've been asking this myself as well, because we have seen consistent short trends for months. I have still yet to see a steepener in the relative positioning and trend signals. That's something that I've been kind of looking for to understand when we might have an inflection point. There was a little bit more pressure on the long end this month, which is something that kind of brought my attention to the fact that we might be eventually at a buying point. It does feel right now, in terms of how we're seeing the markets trade, that we're at a point where there's some interest to buy, because we've come so far in this disinversion in the yield curve. And so I think the next step is going to be, what's the next phase of this bond trade? Is it wait and see if we see something that could push us to a new shape of the yield curve? Or do we go to a state where we have worse financial conditions and we have to actually stop tightening, and thus see, the shorter end has to release some of the pressure?
Are you still short bonds?
Yes.
Okay, so are you basically seeing this as a sign that there could still be more yield increases to come, even though you are seeing a bid to buy come in around the margins?
Yes, Lisa, and what's amazing to me is that signals in the technical space have been short in fixed income for 2 years, almost consistently. That hasn't happened in many decades. And I think what we need to start to see is to see some consolidation and see some actual view that trade might turn around. But so far, I keep looking for it, and I haven't seen the end of this trade yet. So that suggests that we haven't seen the bottom of perhaps the long end of the bond market as of yet. I think we might see it in the next 3 to 6 months.
So maybe yields have more room to climb here, but can we talk about the importance of 5%? Because I think it was very telling that you had the 10-year Treasury yield just kiss 5% earlier this week and then immediately drop. In the path to higher yields, how much of a hurdle will 5% be?
Well, 5% was a pretty important philosophical boundary for many investors, and maybe it also represents a buying point. If you think about it from the investor perspective, as yields go up, there starts to be more and more of a trade-off between at what point do you not worry about the entry point of that particular investment, and you start saying it's actually pretty good to lock in 5% over these horizons, and there is some risk that we might have deteriorating financial conditions, so purchasing those bonds might actually seem like a good idea. And that's what I'm hearing from investors as well. We're starting to see more discussions about the trade-off for the risk of investing in risky assets versus the return of fixed income that has become so much more interesting than it was a few years ago.
Well, we're talking about the level here. Let's talk about rate of change a little bit, because the rate of change has been shocking over the past few months. You look over through the next few months, are things going to calm down?
Well, I think these things come in spurts and in runs. And I think we've gone through a pretty strong run in terms of trends. And one thing that we note in the trend following space is that fixed income is not linear. It tends to accelerate very quickly when it wants to, and then it can be very smooth for some period of time. It feels like we've gone through one of those phases, and now there's going to be some consolidation until we see something that has the ability to move that curve again. So far, we need to have something a little bit more extreme, perhaps some deteriorating financial conditions, or just an excess supply of treasuries that just has difficulty, kind of consolidating.
Katie, don't run away. We're gonna do some data checks here. I want to come back to you with an important question on Alpha Simplex. The S&P futures at -11 here. The VIX 19.06 really shows the good news of the last couple days. Maybe Microsoft will help out with that this morning. 210 spread, -23 basis points. Katie Greifeld looking at 2.45% on the 10-year real yield. That's extraordinary. We have some dollar strength, some resiliency. I don't know what Japan's doing. I got a 149.92 and a frozen yen, frozen fixed peso as that country falls apart. And the 10-year yield 4.86% as well. Any number of other statistics to look at. The 2-year yield 5.09%. The Standard & Poor's 500 down 0.3%.
And Tom, I also think it's important. You said dollar strength. I would say euro weakness, because we have continued to see euro weakness as a significant driver of that pair.
That's the cross-asset nature of it. With Katie Kaminsky here for Global Wall Street, I've really got to ask this question right now. Katie, your world is the foundation of Andrew Lo of the Massachusetts Institute of Technology. He founded Alpha Simplex. He's a giant of my world and Global Wall Street's world. What does he make of a 10 standard deviation move in the bond market? As Lisa mentions, the level, the magnitudes, they're not in Andrew Lo's textbooks, are they? Or in modern portfolio theory?
So these type of events are what the adaptive markets hypothesis would call a punctured equilibrium. I like to call them, for sort of more colloquial terms, an aha moment. It seems like occasionally investors come around and realize that they hadn't realized something relatively important. And I think what happened earlier this year is people realized, wow, I can actually earn something on my savings. And then recently, people finally learned that, wait a minute, we're going to actually have to deal with higher interest rates. And that was the recent aha moment that we've had. Yeah. And so I think what's hard is that we all learn that markets are efficient, but unfortunately, these type of events, particularly in the bond market, seem to be very, very extreme. Right. And we seem to learn them very quickly and sort of all decide the same thing at the same time. And oftentimes it's very obvious ex post. Right. Katie, gotta leave it there, but Katie, thank you so much. The wisdom there of Alpha Simplex and Professor Lo of MIT. Coming up, further wisdom from Chicago, the 8 o'clock hour, James Bianco. From New York, this is Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg. Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Sadly enough, we've gone through many individuals. I did not personally think McCarthy needed to be taken out. The 8 who did that, I just think they caused a lot of chaos. Mike Johnson was the runner-up to Tom Emmer. I think Mike would do a fabulous job. I think he could get the 217. Same with Kevin Hearn. Those two individuals, I think, let's just say it's kind of insane to say, but they wouldn't have as many people against them.
The gentleman from North Carolina getting through this. You wonder what he'll have to say tomorrow in 24 hours. And I gotta say right now, I mean, welcome to Surveillance here. Farrell he's got an umbrella in the Bloody Mary this morning. Katie Greifeld in for John Farrell, Lisa Bramwitz, and Tom Keene. Can I just say the only thing dumber than what's going on in the House is the Red Sox are trying to pick a new head of baseball operations. That's the only thing on the planet more silly than what we're seeing in Washington.
And it probably won't be as raucous and as confusing as what's going on in the House. There's this question, and a viewer wrote in, and it's a good one. Are we now looking at a Trump litmus test for any potential additional House Speaker candidate? Because that seems to be what torpedoed Tom Emmer.
I'll go with that. But, to open the conversation, he is the presumptive nominee. I mean, you got to listen to the guy. I mean, I would think so.
I mean, it's amazing to think of the Tom Emmer experience. 4 hours as nominee, a word from Trump, and he's gone. It's amazing.
If you are just joining and you're not caught up in this House Majority Whip, Tom Emmer was the front runner, and then all of a sudden, hours after he was the front runner, he pulled out of the race after former President Trump said no,
he's a
don't
Republican
think so.
in
He's a
name only.
rhino,
He's a hockey
and
player
that's
in
what we
name
called
only.
him. And then now we have Mike Johnson of Louisiana, a Trump supporter, next in line for the beauty pageant.
We're going to get briefed on this right now. We do this with a mixed market, is what I would say. Look to our ECB coverage tomorrow. Joining us in Washington, our Bloomberg, you got to be kidding me, correspondent Anne-Marie Horton, the starlet of Balance of Power. Who has the balance of power in the House right now, Anne-Marie?
Well, looks like Mike Johnson has it, doesn't it? I mean, I will say one thing. This is the 22nd day that we do not have a speaker for the House of Representatives, but there is a different feeling, mood-wise, about Mike Johnson when there was this roll call vote last night. 3 individuals voted present. There were about 24 that were absent. This is potentially where he can have problem. But there does seem to be some momentum. Maybe it's the exhaustion amongst the Republican conference. Maybe it's not that he's not liked. He's liked, but it's probably more so that he's not hated so much, that this could be one individual that unites them and gets to 217 on the floor, which has been the question and the problem the entire time. They have such a slim majority. Their caucus is so divided between the hard right and still moderates that remain in the Republican Party that it's very difficult for one individual to get to 217.
Emery, your work in continental Europe and out of London, what is the effect of this silliness on our Western allies?
I think they just look at this and they feel like we're here again. They saw a lot of tumultuous politics during the Trump administration. I think they feel that it'll get worked out. But when I was in New York for the UN General Assembly, someone quipped to me that it's no longer the rest of the world. Maybe that changes today, given what's going on in Europe as well as the Middle East. But a lot of consternation and stress that people feel around the world, whether it's heads of states or whether it's CEOs, actually emanates from Washington, D.C. They can no longer feel like they know what's coming out of D.C. There are surprises, like there was last night.
So I'm going to take a cue from the viewer who wrote in and said, are we looking at a Trump test that any potential nominee has to get passed?
I think it has been clear from Tom Emmer really going down in flames, let's say. I mean, he had, the nominee just for hours, and then he dashed off into an SUV after basically Trump ended it. Put out a statement saying he's a globalist rhino. Politico's reporting that Trump got on the phone with someone and said, yeah, I killed him. Without the backing of the former president, this individual was not going to be able to get to that suit 217, Tom Emmer, on the House floor. When you look at Representative Johnson from Louisiana, this is someone who is such a staunch Trump ally. This is an individual that actually was collecting the signatures for an amicus brief for a long shot case in Texas that they wanted to bring up to overturn election results. So someone that didn't just certify the election, but also someone that was actively working to support the former president in his quest.
Anne-Marie, how politically viable is it for some of the more moderate Republicans to get behind a figure like that?
Well, this is what my question really is today. There is the mood music and the shift does feel like it's changing, the feeling. But on the floor, can these individuals actually vote for him? I would note that one CNN reporter did tweet a photo of Speaker McCarthy's office, and that sign that said Speaker McCarthy was taken down last night. So that is why you are seeing this big shift in tone. But there are 18 Republicans in the current caucus that are from Biden-led districts. So is this individual too toxic for them? This person is not as nationally known as, say, a Jim Jordan. So potentially they can get through with voting for him.
Well, Anne-Marie, on the topic of Kevin McCarthy, it's striking to me just how different this experience is than the Kevin McCarthy episode when we went through, something like 15 rounds. Now we're just going through nominees. Why the change in strategy?
Well, Kevin McCarthy went through 15 rounds on the House floor, and I think that a lot of Republicans that were able to get the nominee, Steve Scalise didn't even take it to the floor. Even though they're able to get the majority within their caucus, when they start to then make those phone calls and figure out, are they going to have more than 4 people vote against them? Steve Scalise realized, I'm not going to take it to the floor, whether 1 round, 15 rounds, it's not going to be me. Jim Jordan actually did take it to the floor, but it didn't work for him in a number of rounds. So I think what they saw Kevin McCarthy go through, they realize that maybe it's best I figure this out behind closed scenes. But also, now we are months in. That was January. This has gotten personal for a lot of people, and the battle lines have been drawn for a lot of these people, and they've hardened. So you have a really good feeling of whether or not you're going to make it through before you take it to the floor.
Anne-Marie, you had Dr. Murphy on last night. You and Joe Matthew on Balance of Power had on the gentleman, 3rd District, North Carolina, he's a urologist. He's the real deal. He's got all sorts of academic credibility. To President Trump, are there Southern rhinos? Emmer is up from the deep liberal northeast of Minnesota. Are there Southern rhinos? Is Murphy, who you had on last night, is he a rhino to the Trump Republicans?
I think someone like Representative Murphy is really just one of these individuals that wants to get behind the majority. So if the caucus and the majority decides we're going for Jim Jordan, he's going to go for Jim Jordan. If they decide they're going for Johnson, he's going to go for Johnson. He's someone that wants to see the place legislate again, and he's going to go for the individual that he thinks can get to 217 on the floor. And he made that very clear yesterday. He thought maybe it'd be Hearn. He thought maybe it'd be Johnson. He wants to go for someone who can get to 217 on the floor. I would say that's someone who is not trying to get involved in this fight. Maybe these individuals want to get involved in policy fights, but there's some that really want to stay out of this, while there's others that, it's a great moment also to make a name for yourself, and they're going to get involved.
Anne-Marie Horton, thank you so much. Our Bloomberg cacophony correspondent in Washington. Of course, look to Balance of Power is day by day this torture goes by. On my screen, it's a Bloomberg Professional Service, folks. We look at equities, we look at bonds, we look at currencies. Greifeld nailing it earlier The unspoken here rounded up 2.46% on the inflation-adjusted real yield. When does small business in America collapse? I'm not exaggerating there. When is there a collapse?
Well, and this is what you're seeing on the margins, and this is what we saw in the Beige Book. And I know some people read the Beige Book, and they found a lot of anecdotes in there that pointed to potential weakness. This is what is possibly going to keep the Fed on hold. We haven't seen it, though, yet, because the economy is growing at an accelerating clip.
Well, it's maybe two countries. We'll have to see on that. Coming up from BNY Mellon, Sonia Meskin. Stay with us. Bloomberg Surveillance.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance from New York on radio and television. John Farrell on assignment. Lisa Bramlett and Tom Keene. Catherine Greifeld in for us today. You will get the bit. I've had like 4 or 5 emails. I mean, none of the economics, finance, who cares? Who cares?
Just Bitcoin?
Just whenever you want to go there, I'm ready.
We'll get to it. You know, she's sick of talking about it, but we don't care. Seriously, we'll do something on is it Sam Bankman-Fried? Did I get that right?
The Sam Bankman-Fried story.
We're going to do that here in the 8 o'clock hour. Actually, some really good work by Bloomberg on that. Red and green on the screen. The VIX 19.04, all quiet on the Western front. Dollar a little bit stronger here as well. Yen won't go through 150. Euro won't go through 106. ECB tomorrow, is it, Lisa?
Yep.
121.29 and sterling. What the reason Pharaoh can go away like this and live large is he's paid in sterling. He's made a fortune.
Well, this is part of the deal in order to get the cruise off the ground that you're planning on hosting is that he has to be able to test out a whole different number of places. He's going to scope it out.
Yeah, he's going to scope it out. This is coming out right now. We're doing this breaking news, which is totally unfair to the control room. Amy's okay. She's waking up in the control room right now. Boeing out with earnings. It'll be interesting, Lisa, to see how Boeing readjusts off of legit competition from Airbus.
Yeah.
It's not Boeing Supreme anymore, is it?
And they actually missed a bit, and you can see the shares dipping. We're going to talk more about that, but it really bleeds into the slew of earnings that we've been getting pretty steadily. I do want to talk about some other issues. Under surveillance this morning really does focus on what's going on overseas. President Joe Biden speaking with Saudi Crown Prince Mohammed bin Salman about efforts to ease tensions in the Middle East, according to the White House. This is interesting. It's the first time they've talked since before October 7th. At the same time, tensions flaring at the United Nations, the Israeli ambassador calling on Secretary General Guterres to resign after he said that attacks by Hamas earlier this month did not, quote, happen in a vacuum.
Yeah.
I mean, it just sort of feels like all of these different factions are trying to prevent escalation but can't really coalesce around a shared vision.
My take on this, and you're correct, the flaring's the exact perfect word. In Europe, this made major headlines. I mean, this was right at the top of the fold digitally. The fold, Catherine, is when there's a newspaper and you fold the newspaper over.
I've heard of those.
You've heard of that?
Yeah.
Good.
Newspapers are
ancient history. What else do you have?
No, but it's true. And I think that this, I will just say, yes, it's got a lot of news, but it also highlights how this is a war of information, in addition to it being very much on the ground hot war. Over in the war of information in Washington, D.C., Congressman Mike Johnson of Louisiana is the latest Republican nominee for Speaker of the House. The move comes after Tom Emmer's bid ended shortly after he was criticized by former President Trump on social media yesterday. Johnson, another Trump ally, will look to become Speaker with a vote set for noon Eastern. We already just talked about this with Anne Marie, but I would love your take, Katie, on how much you hear about this as one of the features behind the volatility in the long end of the yield curve. I know that sounds nuts, and yet people are looking for some compass to understand how we're going to resolve some of the deficit concerns.
I mean, you think about all the drama that's playing out at the long end. That's definitely a feature because, again, we're heading into mid-November. We're pretty much at the tail end of October. Shutdown risk is real here. Fiscal deficits, supply concerns, it's all playing out at the long end, and it feels like bond investors are just looking for any reason to worry right now.
Well, they've had lots of them, and that's the reason why I have always kind of empathized with people who focus on bonds. Meanwhile, in the earnings space, Alphabet and Microsoft heading in opposite directions after reporting earnings. Alphabet down in pre-market trading as its cloud business missed profit expectations. Microsoft gaining on growth in cloud computing and demand for artificial intelligence. Meta next up after the close. Amazon reporting tomorrow. Yes, at this point, Tom, how much is this going to be about actual cash coming in the door, especially because you're actually earning something on that cash, which is suddenly something people are pointing to as a possible tailwind with higher rates for big tech?
Yeah, what's important here is the understory, and Bloomberg's Robert Schiffman's done great work on this, is the underbonding of these cash-rich companies. Robert Schiffman looking at Microsoft, for example, with it's a heavy burden, folks. 1.9% debt weighting. 1.9%.
Okay.
There isn't a textbook that says you should do that.
Why issue debt when you have this much money? And oh yeah, by the way, you can actually take this money, park it in T-bills, and earn 5% on that cash.
So that's the thing. I mean, it feels like the narrative has been that you see higher interest rates, that's bad for long duration tech companies. You think about the debt actually on their balance sheets, that's not necessarily the case. Then you take a look at the cash piles. They're making money off of that. Alphabet's interest income almost doubled to more than $1 billion. We learned that yesterday. It's pretty amazing.
Well, and this to me is ironic because we were talking about how higher rates will hurt big tech because of valuations, and now suddenly, wait a second, they've got a lot of cash. They're actually going to earn something. So you could flip it on its head. It seems like tech wins as they win, tails they don't lose.
What you do, this is way back with Grateful Dead records. Doug Cass knows this. You go in and there's a whole row of bootleg Grateful Dead records. And the answer is there's a point where you bought incense there, little candles and and you burnt your incense in your dorm room as you studied Modigliani and Merton and Modigliani theory, which was on capital structure. And basically it said, if you've got the money, issue bonds. And it's fascinating to see what companies like Microsoft do here. Are they going to just completely ignore Merton and Modigliani? That's the heart of the matter.
Patchouli?
Patchouli. Yeah, I can't pronounce it though.
Or was it? I mean, was it something else? The scent?
I can't. It's just too far. Too far ago to remember. That's where we are. Very importantly, Boeing. This is the Airbus competition as well. They cut their annual target for 737 jets. Some free cash flow headlines out there as well. It's interesting to see the challenges Boeing has in a true global duopoly. She studied at the London School of Economics, not aviation manufacturing, but Sonia Meskin is U.S. macro at BNY Mellon, understands international processes, and joins us this morning with her wonderful work at the International Monetary Fund on the Green Book long ago and far away. What is your biggest mystery in international economics now? You have to write for BNY Mellon. You're beginning to plan a year-end report. What's the single biggest mystery you have in international economics?
You know, I think what we're all trying to figure out right now, maybe this is my central banking background, but the infamous R star. What is the appropriate level of rates for this economy? What is the appropriate level of policy rate? And I think it's not just a U.S. story. I think it's a global story because the dynamics in inflation, in supply and demand globally have shifted.
So this is sort of building on what Katie Kaminsky was talking about. How do you follow a trend if we can't find it? How do you follow some sort of narrative if nobody can really figure out what to look at? What's your compass when trying to understand what the new paradigm is globally?
Well, I do think that you start by looking at, well, how much are people saving? Where is the savings coming from or no longer coming from? And where is the investment side coming from today? And we do think that the balance between aggregate savings and investment has shifted. So we have fewer savers, especially in the U.S. as people age out of the workforce. So they start saving less in America especially, and they start spending more. And on the other side, we do have more investment. We saw in manufacturing even, folks were so worried about manufacturing at the start of this year and even late last year, and we're having a rebound, in part because there's this shift from private spending, or used to be at least, to public spending. Now we have all this fiscal support for manufacturing, and the sector is doing well.
This is fascinating to me. We were talking about all those retirees packing out all their cash in their savings accounts, and all of a sudden they're getting to retirement and they're spending it. They're putting it out there in a new way. The new generation, it's YOLO, you only live once. They're spending it. How much does that increase R-star from your vantage point? I mean, how much does that increase both growth and inflation in a level that we haven't really envisioned?
Well, it's important to not only look at the savings side, but also, as we just discussed, the investment side, because I do think inflation is a function of both of those, right? Because not only do you have fewer savers, people are spending more on the consumer side, but you also have more investment.
And Sonia, I want to bring you into the conversation that Lisa and I were having about who higher interest rates actually pinches in the equity market. Because again, the narrative has been that it's those big tech companies, those long duration cash flows that are going to get hit the hardest. That hasn't been the price action so far this year. Who actually gets hurt from these higher rates?
I do think the small businesses a lot more because, listen, they're much more exposed, as you guys just discussed. They're much more exposed to higher rates. They do still employ a good chunk of the American workforce, almost 50% by some estimates. And, for tech companies, I think growth expectations in light of AI have really been ratcheted up. Whereas for the small businesses, of course, not only the financing costs are higher, but also the growth expectations are lower.
Well, talk to us about refinancing risks and sort of the fact that these small cap companies, they have to tap the debt market a lot more frequently than their larger peers. You think about refinancing into this higher interest rate environment. How painful is that right now?
I think for some, much more painful than for others, and it's really important to look at balance sheets. And again, the consumer and profile for each individual business is important as well, because it all comes back to jobs. If people have money to spend, or if they have enough savings, for example, or their net worth has risen considerably, as we know, that is a buffer. That is a buffer even for companies who need to refinance into a higher rate environment. Because just as with the big corporations, just as with tech stocks, if growth expectations still trump their cost of capital, they're in a good place.
An Austrian named Hayek darkened the door at your London School of Economics. He would say you have to clear markets. I'm looking at bank charts. I'm looking at financial industry charts that border on grim. How do you perceive, from an international economics basis, we clear our busted financial system?
Well, in some ways, you know, a yield curve that is somewhat less inverted is obviously helpful to banks. Another thing, of course, is loan demand. And I think that by some metrics, at least, actually, loan demand has been growing a little bit faster recently than earlier this year, which is an auspicious sign.
I mean, from a Hayek standpoint, it's a global roll-up, is what we actually see here. The strong get stronger. I mean, I don't see any other way out of it, but it's a once-in-a-lifetime bond move, isn't it?
Yeah, it's huge. Certainly once in a decade.
Okay, well, Sonia Meskin, thank you so much. With BNY Mellon, some difficult questions there, particularly if you're working for a bank of the character and longevity of the Bank of New York. Their dividend goes back to 1642. You know, we mentioned powder dry Cromwell earlier.
So that's the heritage,
Bank of
talking
New York,
about the paradigms.
They paid a dividend in
shifting.
1642. Stuyvesant cashed the first check.
Who?
Stuyvesant.
No, I know, I'm just kidding. I think, though, that there is this point about all of the older people who are retiring and then spending all the money, and the younger people who believe that you only live once. Yeah. And the whole idea that everyone's spending and the incentive to save has gone down. It's just so interesting to me because it's true. YOLO.
Standard & Poor's 500, negative 11 right now. The Standard & Poor's 500 down 0.3%.
Will we get stability today in the 10-year yield? That seems to be the theme on everybody's mind. And I just keep going back, though, to this theme that we see developing, whether it's Katie Kaminsky or whether it's Sonia Meskin, about this idea that how do you solidify, how do you coalesce around a narrative when we don't know the new paradigm? And that is sort of the message of the past couple of weeks.
It seems like what we have to rely on right now, to Katie Kaminsky's point, is these levels. 5%, that is a big philosophical level. And in this vacuum of Fed speak that we're in right now, of course, in the Fed's quiet period, I mean, that's where we're trading.
Actually, to be completely honest, Fed Chair Jay Powell is speaking today, but it is a non-monetary policy-related conference. Okay. So
What's
it is
he
the quiet
about?
Period. I think he's introducing one of his former colleagues, so it's not going to have to do with monetary policy, but it's not exactly quiet. It's like a, whisper of a quiet.
Well, then we're going to have to pay attention to the color of his tie,
Oh, yeah.
how
God,
his
please
hair is
no.
parted.
That's why I didn't mention that coming in.
ECB tomorrow, we'll have coverage on that. John Farrow reporting from the back of a cruise ship. So I don't know where he is, somewhere. If you're on the stern of the ship and you're going up and down, you don't go up and down the same as if you're up top where you do this thing.
Have you ever been on a cruise?
I've been on a cruise exactly once.
Yeah, and how long did it last?
The captain said, don't make it twice.
You bother the captain, hey, can I drive, please?
It's a long story. I got, is that Grace Kelly? It was very cool.
Star-studded.
It was off Hawaii, long time.
Sort of like Jonathan Farrow.
There you go.
Well, John's out there. He'll be back. I believe rumored Monday or Tuesday or Wednesday.
Monday.
Thursday.
I think so.
On the American economy at 8:30, Stephen Rasciuto. This is Bloomberg's Surveillance.
Josh, that's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
The top names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
When the bond market sets the stock market bouncing between gains and losses, look for babies that get thrown out with the bathwater. The good news is it's the end of free money. It's a normalization of interest rates. Bond buyers are getting something in return. We're leaving a period of emergency liquidity to a more normal environment.
John Stolfus, he has been right on the market. He has been optimistic and is still invested, chief investment strategist at OPCO, Oppenheimer Asset Management. Lisa, you know, all the gloom that's out there, they selected few, Minkum Chadha over at Deutsche Bank, John Stolfus, you know, a number of other people that are saying, shut up, get in the market.
I don't really feel the gloom. I mean, the gloom, I feel from bond traders because they're always a little bit gloomy. And again, I relate. But at the same time, in the equity space, you hear people say, you know, if you've been gloomy, you've been wrong. Yeah. And you hear that again and again and again.
Well, the fact of the matter is we're still sitting on double-digit gains. If you look at the S&P 500, you look at the NASDAQ 100, it's up something like 35% year to date. I know we've stalled out and then some in the last couple months, but it's still a good year.
Yeah, but I'm looking at the select few, not only the 7 that we're going to talk to Alex Webb about here in a moment, but we haven't talked about this morning. We're going to pause for global Wall Street and particularly Manhattan. You know, the banking business is below 60th, 59th Street. Did you know that? I didn't know that.
You're in his camp?
Citigroup.
Right there?
Citigroup,
Yeah.
38.93. On a reverse split off of 2007, it's $3.89. You look at every chart in banking and, you know, forget John Stolfus's optimism. Katie, it's just slipping away.
Yeah, I mean, financials, they are their own special headache, and there are some idiosyncratic issues. I mean, if you take a look at the sector level as well, but I mean, on the benchmark level, if you're just putting money in your S&P 500 tracking fund, you're still having a pretty good year.
Well, okay, you can listen to her. I mean, she's
know,
pretty good year. I got Citigroup under $4 a share, reverse split. Lisa, and what does that say about the regionals or the smaller banks as well?
Yeah, big banks or utilities, regionals are potential candidates for a roll-up. For the what? Zombie roll-up?
Well, it's a zombie roll-up, but you know, you never know the way it's going to be a roll-up, and a roll-up can be constructive, like the oil business that we've seen. People are basically saying Chevron sold Amerada Hess. I don't know if that's true or not, but that's sort of the zeitgeist out there. Is they didn't go to big premium.
It's a different industry when suddenly you're looking at trying to maximize the stuff in the ground before suddenly it's obsolete.
We're doing non-tech chat here before we go all tech. We can do that right now with Alex Webb in London. Alex, your brief was exactly where I wanted to go, which is I'm fed up with a happy talk about AI. What did I learn about AI at 4 o'clock yesterday afternoon, New York time?
I mean, in very simple terms, it is a real thing. There was a certain amount of questioning. We've seen all this spending on chipsets from NVIDIA to build up the data centers that are primarily built by the cloud operators. I'm talking about Amazon, Microsoft, and Google, as well as a few others. Now, they've been building up all this capacity in the expectation that their cloud customers are going to use it. If they build it, will they come? looking at Microsoft, it looks like they are. There's a 300 basis point tailwind that it's got in the most recent quarter from demand for its AI offerings. And of course, its AI offerings are often to do with what OpenAI, the maker of ChatGPT, does. Microsoft is the biggest investor in ChatGPT. They have a very close relationship. There is appetite for that stuff. Interestingly, Google also reported earnings, good numbers when it came to the advertising piece, but in the cloud space, it did not do as well. Suspicion that maybe Microsoft has stolen a march in that AI space and Google is suffering.
Have we used AI to paper over the nuts and bolts of these businesses too much? And I keep going back to the cloud and the fact that, are we seeing Google lose share to the others and really break back to another place while the others surge ahead?
Look, there's a lot of nuance in here, obviously, right? Google is, by a long way, the third biggest player in the space. Amazon dominates it with AWS. Microsoft is a strong second. Google is quite a long way behind. Amazon, right now, has not got the sort of AI offering that Microsoft and Google have. Microsoft, as I said, seemingly a bit ahead of Google, at least in the customer perception. Google has a lot of these things. It's not making a difference. The really interesting thing will be to see whether chunks are being taken out of AWS by this AI play. That will help answer, I think, your question. But, you know, there's a huge amount of optimism more broadly about AI and what that does in general for the global economy. So it's not necessarily about papering over cracks so much as filling them in, and you know, that's a slightly different perception on it.
But how much overlap is there with the cloud computing clients and the clients for the artificial intelligence services that are pretty broad reach, right? I mean, isn't there basically consolidation of market share and corporate investment that you can translate from one section of the business over to the other?
If I understand your question correctly, look, I think AI is going to be touching everything in all of these companies. That is the huge expectation for AI. So the idea that it is just moving spending around, I think may not be completely accurate. I think that if people want to find the savings and also the growth opportunities that AI might be offering, they need to be investing in it. That is probably going to be additional investment rather than reallocated investment. At the same time, Google, one of the reasons that its cloud business did not do as well as expected is because, according to the CFO, Ruth Porat, there has been a little bit of tamping back on spending. So we are still very, very early in this cycle. There is going to be a lot more to come if you judge by the Microsoft experience, but they have to see that it is having the effect that they desire, and the technology is not all the way there yet.
And Alex, maybe for a bit of
I hope that did ask your question, I'm sorry.
My head's spinning. Katie, save us.
Okay. Well, I was going to say, for a bit of a reality check, we were talking to Mandeep Singh earlier, and he made the point that, for Microsoft, AI went from a 1% contribution to a 3% contribution. How high could that number climb, theoretically?
Well, I mean, you know, I'm not an analyst. I'm not in the business of making like those sort of precise predictions. But you know, 3% of a $60 billion business isn't nothing, right? That would make it a unicorn on a standalone basis, presumably. So, it's a cliche. The sky is the limit, right? We don't know how far AI can go, what it can do. The question is when. Is it coming now? Is it coming in 6 months? Is it coming in 5 to 10 years? That's the key question, rather than knowing just in general how big it is.
I mean, Alex, I make jokes about it, but you've been absolutely industry leading on this and brilliant at Bloomberg Opinion. So I'm reading Zachary Cavanaugh at Microsoft, who's telling me why I need Microsoft Copilot at home. And he's got blah, blah, large language models, whatever they are, as well. So they go, ask a work question. So I said, do we miss John Farrow? And, you know, that's what Copilot and I guess ChatGPT can do. When do we get questions like that answered effortlessly? Not this technobabble, but when can Lisa say, is it a toxic brew? Or, you know, how bad is a toxic brew? When are we going to get that in AI?
Well, if you think about it, 5 years ago, we've gone from GPT-1 to GPT-4 in 5 years, and GPT-4's capabilities are very impressive. GPT-1 struggled to put sentences together, right? So if you look at that timeline and the pace at which it's accelerating, it's going to happen very, very soon. The question is the safety element, and does that hold back the pace of the development? It's an important one. It's one that people are trying to answer right now.
Alex, thank you so much. Always learn something there. Alex Webb there on like the more of the philosophy of what we're witnessing, not the financial numbers there with Bloomberg Opinion.
I am curious, though, what did Copilot say to that question?
It crashed the damn server in Arizona is what it did. But Lisa, I mean, this is important. People come on the show, Katie, and they go, it's going to help margins down the income statement by 200 beeps. And I'm like, really?
Yeah.
That's what's coming out of their mouths.
Well, and if you take a look at specific businesses, and I pointed to Moody's earlier saying that they were going to start using ChatGPT.
To do what?
To help with some of their reports to generate them. If you can have, and we were talking about this with Matt Lazzetti of Deutsche Bank yesterday, about how you could use ChatGPT to find certain things, to go through documents really quickly. Why analyze Fed meeting minutes if you can just send your ChatGPT
Why have
after
analysts?
them? Exactly. Well, this is the question, right? At what point does that replace humans versus augmenting their productivity, which is another word also of cutting out some of the work?
And maybe that eventually translates into margin help. But in the meantime, I mean, these companies are spending so much on AI and research and development that has to hit margins.
Well, maybe, although it might be worth it if they can potentially get rid of some redundancies. I hate that.
I've got smart people telling me that this is going to work in selected areas. But, you know, we make a joke about it, but are you going to be able to go, which is the toxic brew that matters today, and it's going to churn out? I just don't buy it.
Maybe with less poetry.
Another way of search, though. It's a more accurate search function. So if you think about how much Google improved people's efficiency, some of us use Google to find information. Just imagine how much more you can do.
Sclerosis? I Googled that about an hour ago.
Sclerosis. But then it gives you a better, more curated history.
I yearn for Lycos. Dogpile was there before Google. Google bought the algorithms of Dogpile. It's like, wow, you can do that? Alex Webb, brilliant there on what we see from Microsoft. Earnings this afternoon as well. This is Bloomberg. Good morning. Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth
behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
Clearly, the consumer is holding up better than expected.
The good news is it's the end of free money.
Investors do expect some sort of a slowdown, but certainly not a collapse.
Over the next several months, there is this backdrop where inflation could very well firm.
They have to get inflation under control. We're not in that territory yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Waiting for knives to stop falling so you can jump back in from New York City for our audience worldwide. Good morning. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz. John is still on his cruise. Katie Greifeld very much with us today, which is a good and beautiful thing. Tom, this to me, you've been talking about the gloom. I see it the opposite way. The tone to me is waiting for a trend that could give you enough confidence to go buy big tech and everything else.
The gloom is there, and the confidence to buy big tech was witnessed by Microsoft yesterday. There's issues of seasonality here, the time of year. But I don't make a small issue. We haven't talked about this, is buybacks click in. I don't really understand the legality of it, but all of a sudden everybody can buy their own shares. And, you know, they come out with their earnings, they all get done, they all go to some spa and, you know, do Zen and all that. They come back and they do bond issuance. I just wonder if that's what we're going to see from West Coast techie here. They're going to come back and do gazillions of dollars of bonds that they can sell with 5 phone calls.
You come back from a cruise and are talking about spa and patchouli.
No, that's what they're doing. They're out there going home, and they're going to do, you know, $20 billion.
Here's the thing: that what you're seeing is immense cash flow, and what you're seeing from these tech companies is a rigor. And regardless of whether you want to parse through some of the nuances, as we heard from Mandeep Singh earlier, it's a really good picture. So, at what point do you just wait for some narrative in the bond market to let you have some conviction with a narrative to drive forward some sort of buying thesis?
Yeah, when things finally stabilize, then you stop obsessing over price return. You think about total return. You look at 5% on a 10-year Treasury yield. Think about the risk reward there. It doesn't look too bad.
At this point, though, we are wondering if we have seen stability. And Tom, you were talking about calculus. Katie was displaying some earlier, but it really is. I mean, but this is the issue, right? Is that we have had to deal with the calculus of a bond market that was stagnant for so long, and suddenly was a jump condition, to use your phrase.
We're going to make jokes about this, but that's the heart of the matter, folks. Here into October, into the Fed meeting with our coverage here, I believe the first day of November. And then it gets even more interesting into December. And it's about the rate of change. It's about the rate of change of the rate of change, the accelerative tendencies, and the way they're linked together across equities, bonds, currencies, commodities. But then you get to what we heard from BNY Mellon, the jump conditions, the true instabilities out there where it's a regime change.
Which is maybe why we're getting more angst around the geopolitical situation as well as what's happening domestically. And Katie, I loved your question earlier when you said, what's more important next week? What we hear from central banks, what we hear from earnings, what we get from economic data, or the refinancing agreement, where the U.S. is going to be selling a lot more debt.
Because if you rewind back to early August, it really feels like things have been super funky since we got that initial refunding announcement where the Treasury announced it was going to be selling more debt than the markets had been expecting. I know there's a lot of issues going along at the long end, but that seems to be really when things started to take off.
And Tom, haven't you been surprised on some level that we haven't seen your zombie roll up yet?
We've seen selected zombie roll-up, and what's fascinating to me is the mating in the oil patches of Exxon and Pioneer and Chevron and Amerada Hess. And I'm sorry, folks, it's not Hess, it's Amerada Hess. Get over it. And the answer is clearly the pros are telling me they were not done at a premium markup. People are mating not for financial gain; they're mating for scale, because that's their least worst opportunity.
And we are seeing the latest in that Stellantis, this crossing just moments ago. Stellantis said to be near a deal to buy 20% stake in Leap Motor. We'll get you more on that in just a minute. Kind of curious given some of the strike activity going on as well. In the markets, softness, a little bit of softness. It's hard to get too excited or too depressed about this. Declines about 0.25%. But what you can see is dollar strength, at least versus the euro, after some of the economic data that came out. 10-year yields. Have we reached stability? Tom, do you think so?
I don't think so, in the sense that on a technical basis, the damage was so great that we just have no idea. It depends on which way the line's going, but there's no support or resistance trend path to work with. It's in no man's land. And, it's a cop-out, but it's true. I need more information.
Which is the reason why people are waiting for some stability before saying, okay, I can actually cling onto some sort of thesis. Someone who has been very good with this is Jim Bianco, president and macro strategist at Bianco Research. How much are you just waiting for the knives to stop dropping before you can really go out there and have some conviction?
Oh, I think that's the key, is that you have to wait for the knives to stop dropping. And the problem is that everybody's been trying to catch them, and they've been falling into this trap over and over, or getting their hands cut, over and over again, to stick with the metaphor. But I think what we forgot, and what I've seen in a lot of the discussion about the bond market, was 2009 to 2020 was the QE period. Let me say it bluntly, that was the abnormal interest rate. We have not gone up. I know we've gone up 500 basis points, but we have not tightened by 500 basis points. We haven't tightened by anything close to 500 basis points. The first several hundred or few hundred of that was just getting back to neutral. So the amount of tightening, or the amount of stress that the interest rate market is putting on the economy, I don't think is as great as people think, which is why tomorrow when we get GDP, we're probably going to see a number that could very well have a 4 handle on it. And this is the same quarter that in June, right before it started, the consensus forecast was for 0. And we're starting to play that game again, that the economy is about to turn down yet again. We've done this now for a year, that we keep saying this, because the assumption is that these rates are punishingly high. If they're not, then there is room for them to keep going up. And I think that's what they'll do.
Which is the reason why I sense a shift a little bit on the margins of the narrative, this feeling that if bond yields stabilize here, it's not Armageddon. It's not going to cause the demise of any kind of stock rally, but the opposite, that the stability will allow people to come in, buy equity, buy riskier securities, because the economy is withstanding these rates. Do you think that that is an accurate reflection of how people are thinking?
Yeah, it is an accurate reflection that, if things are not as bad as we hope, then, earnings will come through, the economy will stabilize, companies will have a little bit of a brighter outlook. However, you got to also put that against the alternative. And the alternative is a 5.5% money market fund, and maybe very well in the next couple of weeks, a 5% bond fund as well. Dr. Jeremy Siegel updated his great book, Stocks for the Long Run, this year. There's a new edition out. And in it, he says that the long-term return for the stock market is 8%, over many cycles, up and down many, many years. Well, if I get 5.5 in a money market fund or 5 in a bond fund, I'm getting like half to 2/3 of the stock market's gain with no real market risk, or much reduced market risk. So the stock market's got to do something more than just, oh, we beat our earnings and things are somewhat bright and everything's okay. They got to do better than that, because there is an alternative now, and it starts with a 5.5% money market fund.
Jim Bianco, the real yield where it is, and you're one of the few people I can talk to this about. You and I remember when there was a great specialty chemical roll-up. Everybody went out, ripped apart the companies that made chemicals and said, here's what's special. It was basically a big zombie roll-up of some productive companies as well. Are we at a point, because of a new real yield, because of a new cost of capital permeating the system, that we get a great merger-thon?
I'm not so sure we're going to get a great merger yet, because I think people are really misreading the real yields, and they're not ready to really react on it, because you hear this, battle cry that real yields at 2.5% on the 10-year tip is at the highest since 2009. Again, it's the highest since the QE period. What was the average real yield from 1997 when they started trading them to 2009? It was 2.7%. And we're at 2.5% right now. So I think once people start to recognize that these real yields are not punishingly high, you might start to see that merger activity start to pick up. But right now, everybody seems to want to wait for, yields to start back down. Earlier, you said, we're going to see the tech companies start issuing bonds. If we did, that means that they think rates are going a lot higher. So I suspect the answer is no.
Late October victory lap, Jim Bianco, folks, way out front of inflation at a level or even ticking higher, as we saw in parts of Europe today. Bianco absolutely nailing that call. Does that signal that the great moderation is over?
I think it is. I think that era ended in 2020. I've been on the show before and I've talked about that. 2020 was arguably the most important economic event of our lifetime, a complete shutdown and restart of the economy globally, and it has now been coming back differently than it was before. And that whole era of zero rates, the great moderation, and I would maybe even talk about top-down index investing on the equity side, might be changing. And now we're going to be looking at more traditional cycles of 3-4 year recessions. And we might be looking at stock picking making a big return after 20 years of being in the wilderness, versus index funds. And we're going to have to start to understand that this is a very different environment.
And Jim, we don't have a ton of time left, but I want to talk about the shape of the yield curve, because what we've seen so far when it comes to this 2s10s is a bear steepening. Typically, it's the bull steepening. That's the recession signal. What signal is this bear steepening sending?
That inflation is not yet behind us. If the Federal Reserve wants to back off of their rate hikes, and wants to say the market is going to do its work, be very, very careful. Because when the market starts doing its work, it will do it. You want the market to slow things down, it will slow things down. Look last year in the UK, when the market didn't like the mini budget and Parliament wouldn't do anything about it, the market stepped up and did something about the mini budget, and Liz Truss couldn't last longer than a head of lettuce. So be very careful when you say, let the market do your work, because it will do it, and it will do it in a way that will scare you. And that's why we think we're getting a bear steepener right now.
10 more questions. We'll get to them. Jim Bianco, thank you so much with Bianco Research for another time on some of the vicissitudes of the American financial system. Jim Bianco there, just folding in the economics into the equity market as well. Speaking of the equity market, red and green on the screen. It's been that way all morning. Don't really know what to make about it other than we wait for tech earnings this afternoon. The VIX now under 19, 18.96. The 2s10 spread, negative 23. Not much. There's 6 basis points of disinversion, but noise. Katie Greifeld nails it with the 10-year real yield, 2.45%, a higher real yield. The Standard & Poor's 500, negative 10, down 0.2%.
I love what Jim just said there. He was saying that he views 2020 as the biggest financial episode of our life. Did you shut the economy down, Tom? And then you restarted it, and it looks completely different. And that's where we are.
Yeah, that's a pandemic. And the question is, are we along with that? We didn't have time to get to it with a number of these guests, including from BNY Mellon. But my missed call of the year was underestimating the legs and magnitude of fiscal stimulus. Olivier Blanchard talks about the Biden stimulus, that third tranche that we had, and I just completely misguessed the oomph of that.
And
through the year.
Yeah, I agree with you. I mean, the magnitude was there to see, but you think about the legs that it has, the fact that it's still having an impact, and you can see that clearly. I think that lasted a lot longer than many were expecting.
Yeah, but at this point, that's the reason why it's interesting that despite 5% yields, which 2 years ago, if you had said to anyone, that's where we would be, they would say, yeah, well, I imagine that 25% of the high yield market is probably in default. That's not where we are. That to me is really the takeaway because of that strength and all of that savings.
Yeah, you saw it in the banking system, those higher yields, the sharp increase causing a hiccup. We haven't seen that in the broader high yield market. I saw an amazing stat in a Bloomberg article yesterday, and I knew this, but it crystallized it nicely. In 3 years, 10-year yields have increased 4 percentage points. I mean, that is just amazing, and we're still seeing a lot of resilience in the stock market, in the economy.
Tom, I will just tell you this. A lot of people are writing in, where is Pharaoh?
Where is Pharaoh? ChatGPT.
Yeah, well, and what cruise is he on?
That's what I'm trying to figure out.
He actually wanted to go to Antarctica because he wanted to see the penguins.
My head was really high up. It was like standing on a skyscraper. You could look out his room and see the port, and you could turn around and see the starboard. It was amazing. This is Bloomberg. Good morning.
Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose side.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
If you, like the United States, want to prevent this conflict from spreading, tell Iran, tell its proxies, in public, in private, through every means, do not open another front against Israel in this conflict. Do not attack Israel's partners.
The Secretary of State at the United Nations Security Council ministerial meeting as well. He will no doubt have a busy day today. Oliver Cook traveling today, but I'm sure we'll have more from him. And Ethan Bronner leading our coverage in Tel Aviv this morning. Futures -9, Dow futures a little bit of green there. The oddity, I'm going to give that to Microsoft. We'll have to see as well as an adjustment. Gregory Vallier of AGF Investments writes every morning, he says geopolitics could be, quote, the trickiest issue in next year, 2024, as public opinion, especially among young voters, seems to be shifting towards isolationism. The idea of spending another $100 billion on Ukraine and Israel, it's increasingly unpopular. Nevertheless, Biden has a political opportunity to become an effective wartime president, this with decent support in Congress. That from Greg Vallier. And Lisa, this is something I brought up. You've heard me like a broken record talk about America's history of isolationism and is now a demographic isolationism.
And how much is that going to really play out, especially into the next contours of a two-front conflict, right? It's both in Israel and Ukraine. Greg Vallier joining us right now. I want to start there. Is there the political support to support Israel in addition to Ukraine going forward through not just the next month, not just the next 2 months, but 6 months to a year?
Well, that's the key question, isn't it? And I do sense over the last few weeks a waning of support. I think that Biden has enough backing in the Senate. I think he's got Mitch McConnell and Lindsey Graham and many others who are very hawkish. But I'd say young people are not enthusiastic. A lot of Americans don't want to spend $100 billion more. So it's soft, but I still think that Biden has enough support to get an aid package, probably not until the middle of the winter.
Greg, what do you make of the fact that you're essentially getting a Democratic Party that doesn't seem to back Israel and is actually moving away from it, and a president that's trying to lead the charge in that effect?
Well, it's quite a dichotomy. It's really almost shocking to see the Democrats, the party that supported Israel so aggressively for decades and decades, now looking a little bit softer. I do think, though, that we will get a deal done. My issue is the timing. I think we're still many weeks away from anything new for Ukraine, Israel, Taiwan, U.S. border with Mexico. That's still a ways off in terms of getting it enacted.
Well, Greg, walk us through the ramifications of that. If we don't get an aid package approved until mid-December, as you outlined, what would that mean for this war?
I think it sends a very bad signal to our allies, at the least ambiguous, but I would argue it sends a signal that the U.S. is losing a bit of its resolve. You know, we all recall in the last year and a half, that was the big issue, that we would lose our resolve on Ukraine. If we lose our resolve on Ukraine and Israel, that to me sends a really negative signal.
And let's tie this into what we're seeing play out in the House right now and the efforts to elect a speaker there. Because 2 weeks ago, I would have asked if the Israel-Hamas war would have put more urgency behind this process, but that doesn't seem to necessarily have materialized, Greg.
No, it doesn't. I think this deadline of November 17th is going to come and go. I can't see them getting a budget done by the 17th. So the new speaker, if we get one, because nobody's ever heard of this guy, but he has a pretty good reputation. He also is a denier that Biden was elected president. That is not my cup of tea, but he has denied frequently that this was a fake election result. He's going to have to answer for that. But I think we're going to go well past the 17th of November to get a deal done.
How much, Greg, is former President Trump driving the bus here? We heard from him this morning congratulating all of the congressmen and saying that Mike Johnson is the strong suggestion from him.
Well, it looks like Trump has veto power, doesn't it? The guy from Minnesota he lasted for like 8 hours before Trump, and then Trump boasted that I killed the nomination. So Trump is taking a very overt role in the House, and I've got to think there are a lot of House members who resent it.
How much is there still discussion about some sort of bipartisan answer? We heard that for a hot second, and then it was dropped because it was politically not viable on either side.
I wouldn't put the chances at much more than 20%. If that, I think it's unlikely that we could get it. If this thing totally breaks down and we get into the winter without anything, well, then all bets are off. And I think Hakeem Jeffries might have to intervene, but it's not coming yet.
And Greg, this drama, this disarray that we're seeing in the House among the Republicans, have we seen the Democrats try to capitalize off of that?
Not as much as I would have expected. I think they're sitting back. What's the old saying? If your opponent is self-destructing, don't get in the way. So I think the Democrats will stay pretty muted, but at some point they may have to be called to enter this fight.
Greg Valliere, I want to go back to a comment you said, because I really think we need to paint this picture. The New York Times reporting, Mark Santoro, of the war east of Kherson. This is down by the Black Sea, folks. This is east of Odessa, east of Romania. And Ukrainian forces are surprising by moving east along the shores of the Black Sea, again, east of Kherson. What do they need from us that's going to wait for the winter financing by America? Do they literally run out of artillery, run out of ammunition?
Well, timing is everything, Tom, and I think that they've only got another few weeks before it's the mud season, and we have 4 months of mud and ice and, you know, basically a stalemate. They will get more arms, I think, from Western Europe, but again, looking at Washington, I think it's going to come later rather than sooner.
All wars have always been marked by propaganda efforts. We've always seen that through history. It's something very notable. This time feels different, though, whether it's Ukraine or whether it's Israel, and some of the images that are coming out in social media, some of the battles that are coming out in social media. How do you view this information war as having a materially different nature than previous ones?
Well, the first casualty of war, as we all know, is the truth, and I think it's going to continue to be very difficult to ascertain who's winning, who's losing. I don't think that's going to change.
Greg Valliere, thank you so much. With AGF Investments, always an important morning note here on our multiple war fronts. And you know, I think this has been underplayed this morning, but I'm going to go back to my triangulation theme, which many in international relations were talking about. Again, I can't say enough about Daniel Byman at CFR, but Israel's not just about Gaza. It's about, he would suggest the West Bank is a huge focus away from the atrocity of Gaza, but then there's also, of course, Hezbollah up by Lebanon. This is a multi-front war.
This is a multi-front war already when it comes to information, when it comes to the emotion behind it, when you see the protests emerging in many places, when you see the clashes on social media. At a certain point, how do you move forward? And we were talking about that earlier this morning. How do you move forward with a viable solution if people still have sort of these issues that are coming to the fore, unresolved issues from the past?
Katie, please.
I was going to say, I mean, the fact that it is a multi-front war, that there's so many actors involved. I keep thinking about what Secretary of State Antony Blinken said yesterday, a very direct message to Iran, basically saying, no, Iran, your proxies don't attack America, because at that point you have to get involved.
Well, there's that, but I'm going to go again to the military. I don't think the Israeli military is a multi-front war. They just want to be sure they try not to kill so many people. I mean, it's just that abrupt. And it bounces up against all the other rhetoric that's out there.
Israel right now, what I find most interesting are some of the conversations about the pressure that international leaders are placing on Israel. We're going to talk about this. We're also going to talk about some of the earnings that are coming out after the bell. That's all coming up on the Open. Patrick Frizzetti of Hightower, Zach Griffiths of Credit Sites, Amy Silverman of RBC, and Daniel Salman of New Street Research.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg surveillance, good morning. Interesting day. ECB tomorrow. It'll be interesting to see a Pharaoh-less ECB. I don't know how we're going to survive that. Lagarde heated at the IMF meetings about an ECB that needs a trajectory to 2%. I'll have to see. Katie Greifeld in for John Farrell. Bramall getting ready for a 9 p.m. ordeal. I look, Katie, at ECB, and it's just not the same story as the Fed. It's just a completely different dynamic.
And I find that so fascinating because for so long, years coming out of the pandemic, and in the pandemic, you had these big developed market central banks moving in lockstep. But now we're seeing more idiosyncrasies in their economies, and you have to see a much different response from these central banks.
Every nation for themselves, maybe is what Ian Bremmer would say. And we'll see that tomorrow. We'll give you some good coverage from Frankfurt on that. Right now, with red and green on the screen, earnings, tech season in full force here. Look for Bloomberg Technology for a real analysis of that in the noonish hour. We get rebriefed here. He's been on the show way too much. It's a faux pas of our team, but actually huge value add. Stephen Rasciuto joins us now, Chief U.S. Economist at Mizuho Securities. We all get the consumer boom. We all get that we were wrong. We're in the vicinity of 5% Q3 GDP. Okay, great. But I got an I got a G, and I got an NX on the back end. Are they going to help out the booming consumer?
That's the real question. I think you could look maybe for a little bit from trade. The real key question is the government component, because to be honest with you, we don't have any good a priori data when it comes to government spending. We do have the monthly Treasury Statement of Receipts and Outlays, and we can look at that, but those don't translate well into the GDP accounts. They don't translate as clearly as other components do. So we're looking at most of the other components and saying nothing else is contributing, so you're down to maybe a little from trade and how much we get from government.
Is there a separation in the eye of big business, ginormous business, successful, profitable, Microsoft-like business investment, and everybody else flat on their back?
Well, there clearly is. And when you look at the shipments of non-defense, non-aircraft capital goods, which is the key driver of the equipment investment components that you're looking at, they're really showing you that on a real basis, we're doing nothing in terms, on average, in terms of investing in this economy. But in an environment where you still have sort of an excess supply globally of tradable goods, it's not surprising that we're seeing that.
And I want to talk a little bit about a story that ran on the terminal yesterday, that if you take a look at the deficit, the U.S. government ran a $2 trillion deficit in the fiscal year through September. And then you think about what's happening in the bond market. You think about a 10-year at 5%. Does that level make more sense when you think about the deficits that we're running?
Well, it certainly makes more sense when you think about the deficits we're in, but it also makes more sense when you ask yourself the question, what level of inflation does this Federal Reserve want? You know, they seem to give lip service to the 2% numbers, but they seem to also be paying a lot of attention to the employment aspects. So they've kind of shifted the dual mandate, where it used to be inflation first, then employment comes along as a result. Now it's almost like, well, we want to get employment first and see what happens with inflation later, and, you know, maybe we'll tolerate 3. So the upward movement in the 10-year note is reflecting a new fair value, which I don't think markets have fully discounted yet.
So does that tell you that they still see that link between the unemployment rate and what's happening in inflation, that to get inflation back to 2%, you do need to get unemployment up?
I think most investors see that. Unfortunately, I don't think this Federal Reserve does. And if you were at the New York Economics Club lunch the other day with Jerome Powell, you really got a sense that these people, or he in particular as well, are looking at the things like the JOLTS data, which, to be honest with you, there isn't that much history behind the JOLTS data, number one. And number two, the history we have is only available for what we call credit recessions that were driven by a credit crunch. This is not a recession that would be driven by a credit crunch. This is an inflation monetary policy, and that's a different story. And therefore, the reaction function is very different.
Did you feed David Weston his questions? They were so vicious and so mean-spirited. I'm like, Rasciuto's giving him those questions. You know.
I thought he could have gone even harder, but he did.
Yeah, well, you know, that'd be like if Farrow was there. Can you imagine John Farrow doing the Economic Club in New York?
It would have been good television, I have to say.
It would be good entertainment. It'd be, you know, it'd be sport.
Yeah.
Powell I don't think it was game-changing. I think he's just trying to get from event to event, waiting for the data, Katie.
I will say that the thing that stuck with me from that appearance was the focus on financial conditions. I mean, I think he said financial conditions at least 15 times. When you look at financial conditions, you think about the lag of monetary policy. Have we finally started to see that?
Well, see, I don't follow the financial conditions indices that are on the street, particularly because they're reflecting long-term interest rates, which, to be honest, we should be driven by inflation, not by real rates. That's number one. Number two, I don't look at it because they're looking at currency, and the currency is really not part of the financial conditions in the marketplace. I look at the availability of companies to bring paper to market and get that paper sold. And I look at the Treasury's ability to bring a ridiculous amount of paper to market and get it sold. And all these markets are functioning beautifully. So I sit there and say, you know what, there really isn't illiquidity in the system. Financial conditions aren't tightening in the sense that really matters to the economy. It's tightening in the sense that we're trying to measure what would cause a credit crunch, but there is no preconditions for a credit crunch.
Right.
There's no asset liability mismatch, and there's no valuation problem to be triggered. And therefore, these things are looking for the wrong indicator.
Halloween, I'm going as Gamma this year. It's my Greek letter this year. But after Halloween, we've got a Fed meeting and we have a jobs report. The first jobs report question for October, folks, with Mr. Rashudo of Mizuho. Is it finally going to slow down?
I don't think so. No, because you're in an environment still where the initial unemployment claims are telling you that we still have a very, very tight labor market. The continuing claims numbers are telling you we still have a very, very tight labor market. So the people that are getting laid off are getting hired fairly quickly. So I don't think it will show up. And will there be some potential for a little bit of weakness in the payroll employment number and the headline number month over month, a little bit of a change? Sure, but we're not seeing any real substantive change in the underlying dynamics of the labor market.
Steve, thank you so much, particularly for the frequent visits as well. Really, really valuable. Stephen Rashudo with us with Mizuho Securities today. Without question, the number one thing Bloomberg surveillance has dropped the ball on in the last 10 days, the horrific narrative from the Eastern Mediterranean, all the other distractions, including a generational bond debacle, is the labor economy of Detroit and Dearborn. We have to have an update. We do so this morning with our David Welch. He's Bloomberg Detroit bureau chief, herding cats and trying to figure who gets the Lions tickets this weekend. David, I guess it's worse. I saw the Ram pickup factory is going to go out as well. Have you been surprised by the worserness of the strike as we've staggered through October?
Not really. I mean, we knew there was going to be a strike, and with the rhetoric from the union, new union president Sean Fink, he promised to go for quite a bit, bringing pensions back, bringing back cost of living allowance, all of these sort of 90s, 2000 era benefits, big pay raises. He started off wanting 40%, actually compounded it would be 46%. You know, when you get the membership in a lather over huge benefits and pay like that, you have to deliver something that's really strong. And the companies were you know, as you can imagine, really far apart on that.
You know, but I'm going to look at your hyperdrive thing. Craig Trudell writing this, and I'm sorry, Mary Barra is not on the same page. She's trying to figure out technology forward. Explain the disparate, almost time zone between a UAW and their nostalgia and Mary Barra and her EV challenges trying to figure out what 2027 looks like.
This is sort of an existential question for the union. The workers just want to keep their jobs and keep making money, and they see electric vehicles as a threat. And for obvious reasons, right? The battery plants that are coming are all non-union. They're all jointly owned with Asian companies that don't have unions here. And the unions have to go about organizing them just to get influence in that part of the industry again. And that eventually would replace engine and transmission workers. And look, based on what GM told us on earnings day, it's going to take longer for that to happen. So the union's got some breathing space, but they're still working on that now as part of this strike, is getting some sort of guarantee or at least a framework and an understanding about how workers who work in battery plants and other EV, electric vehicle parts facilities, how they'll be paid, compensated, what their benefits will be like, and whether or not they have union membership. And the union wants the companies to help them with that because they don't want to see their influence go away because technology comes about.
Well, David, talk to us about the distance that still remains just on the wage level, because I'm looking at Bloomberg's reporting, all three companies offering a 23% wage increase. I know the UAW has been pushing for 25%. It seems like maybe we're starting to get closer.
We are, and Sean Fain even said that on Friday, and so did a guy named Mike Booth, who's a vice president of the union, told me that out at a rally in Detroit on Thursday, that the pieces are there for the economics, and they're pretty close. GM and Stellantis are fairly close to Ford's offer, which is a little bit better than theirs on things like cost of living allowance and pensions, and I think they can get there. What's going on here is the union added a strike at the Ram pickup plant and the Cadillac Escalade, Chevy Suburban, Tahoe plant in Arlington, Texas. And Sean Fain sort of telegraphed this too Friday. He said the last mile can be the toughest one. He told workers to be prepared to strike. And I think he's trying to, he knows they're close. He knows they're getting about as good a deal as he can get. But hey, he's got plenty of money in his strike fund, and he's going to walk out at a couple more plants to squeeze out every last penny he can in this contract. And I think that's what's going on now. So I think they are fairly close, but he's also a wild card, and he's been known to move the goalposts. So we'll see. But I think they are pretty close. But, you know, if you have one thing they don't settle on, that keeps everybody out.
Yeah, the Fain wild card. But you think about some of the economic damage that's being inflicted on these companies. GM yesterday, even though they pulled their guidance, of course, they don't know what their profit will look like. They did say that strike costs alone have reached $800 million so far. Is that the case at Ford, at Stellantis as well?
They haven't told us, but analyst estimates are pretty similar amounts of money. In fact, Ford's damage from this was a little higher because they walked out at the Kentucky pickup truck plant before they hit the GM and Stellantis truck plants. And those pickup truck plants, look, they sell pretty pricey vehicles and a lot of them, and they make a lot of money. But they're all roughly in the same kind of damage. There is sort of a bit of perspective here. When the union shut down every General Motors plant for 40 days back in 2019, it cost the company, I think it was $3.2 billion. So this fact that they're doing these walkout strikes, adding a plant here, a plant there, it does really reduce the economic damage. But even if they get a tentative agreement this week, it's probably another couple of weeks to ratify it. So there'll be more losses, even if they get a settlement very soon.
Thanks for the brief, David. We've been remiss on this in the last number of days. David Welch driving the ship in Detroit and Dearborn for Bloomberg. The VIX under 19, 18.95. Boeing and Microsoft may be distorting things a little bit. Crude oil under $84 a barrel. Standard & Poor's 500 down 14 points, 0.3%. One of our agreements with Katie Greifeld's people is they said to us, you know, really on the back end of the show here, you got to go crypto, all that. And we're going to do that. In the next block, we're going to talk about SBF, Sam Bankman-Fried. Nailed that. We're going to talk about, this is really important with all the hysteria out there that's been going on. We're going to talk about this with someone with massive cred on this and massive authority as well. Right now, though, we got to get a picture here of BitDog. We do this with Catherine Greifeld, of course, with all of her work with crypto and true reporting with our team on Binance and the rest. And the moonshot of crypto from pandemic level is up 69,000. That's where I loaded the boat. And then down we go. And I guess we've recovered. And I guess it's a trend with a friend. Can you say bull or bear market in Bitcoin? Is that actually logical?
The term actually, instead of bear market, you say crypto winter. And we've definitely been living in a crypto winter. You are seeing a lot of enthusiasm come back, at least into the price right now. But a lot of that, it seems to be predicated on hopes that we're finally going to see a U.S. spot Bitcoin ETF launch. If it does, I would just point you back to that chart. When we saw the futures ETF launch about 2 years ago, it top-ticked it. That was a sell the news event. We got up to $69,000. Haven't been there in a long time. We'll see if it's a similar experience this time around.
Greifeld, just fantastic. Bitcoin charts on radio, that really works. Coming up on Bloomberg Originals, it is Ruin. It's on the fall of FTX and Sam Bankman-Fried, and just critically, this is a gentleman at Bloomberg definitive on the truth and SPF. Stay with us. This is Bloomberg.
knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
I think he just had the mentality that he has to win.
It was almost like trying to explain like business ethics 101 to a baby.
Sam has basically become a villain in everyone's minds.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. I'm in.
I'm in.
We're in.
Finally, that's all I'm going to say. It's finally. This is the absolute definitive zero BS view of this folly. It is ruin. It is a Bloomberg Originals. It is, I guess I'd call it almost mean-spirited in its abruptness. It is absolutely extraordinary, and it is extraordinary because of Zeke Fox. Who in God's name is Zeke Fox? Katie, help me here. Number Go Up is the definitive book on this. My good friend Michael Lewis has done, it's a more Michael Lewis treatment. And Zeke just went out and did Number Go Up and said, hey, here's the reality.
I happen to be friends with Zeke, so I particularly like this book, and he did a lot of reporting for it, too. The work that went into this book, Zeke traveled around the world for it, and that really comes through. And I actually read this book on vacation, and I try not to read too much on vacation.
I'm trying to read the you drive down the road and you read it on it. Joining us now with a victory lap on ruin, Zeke Fox joins us in Washington this morning. Zeke, congratulations. You tear apart the celebrityness of this. I love it. You've got in that thing we just saw, folks, all the people smiling, going, do it, or whatever they were saying there. When did you realize that Sam Bankman-Fried was in trouble and there were some serious issues?
So I spent a lot of time with him when things were going great, and he was amazing at seeming like he had nothing to hide. I went down to the Bahamas right after the Super Bowl when he aired those, don't miss out, buy crypto ads. And he was just like, yeah, pull up a chair. Watch me do my thing. He's emailing with billionaires. He's doing interviews with other reporters, all the while playing video games. And so I wish I could say that I suspected something was up, but I didn't realize. I thought it was obvious that he was running a crypto casino where people are going to come buy random coins and maybe lose money gambling on them. But I never suspected that he was stealing all the money out the back of the casino.
Yeah, Katie, jump in here with your good friend Zeke Fox. But I'm just going to suggest Farrow, Abramowitz, Greifeld, Keene. Are we going to the Bahamas? I don't think so. This guy's got the dream gig.
You know, I was actually supposed to go to that conference, and I got COVID, and I couldn't go, and I really wish I had. But Zeke, talk to us about the evolution of your reporting, because as you lay out and you own it, you know, you didn't catch it, but then you did. So what was that process like?
So I was very suspicious of crypto. I was skeptical that there was really anything there. And the funny thing about Sam Bankman-Fried is he had this when he met somebody who was crypto skeptic, he presented as someone who was skeptical too. And he would say, hey, you know, yeah, there's a lot of scams out there, but I'm running this great exchange. I'm just going to collect a little fee on each trade. And as long as crypto exists in some regard, I'm going to make money. In a weird way, even though he looked like a kid who'd been up all night playing video games, he presented himself as kind of the adult in the crypto room.
It's a great point, too, that the cynicism that he seemed to express definitely gave an air of legitimacy. But talk to us about how the wheels finally started to come off. About almost a year ago at this point is when we saw that implosion. But that followed months and months of scandals. I mean, you think about what happened with Luna, for example. What was the domino effect that led to FTX finally imploding?
Yeah, so in the summer of 2022, this like crypto house of cards collapsed, and Luna, which was like almost openly a Ponzi scheme that had $60 billion, collapsed, and there were all these crypto lending companies that had lent billions of dollars to crypto hedge funds to invest in different coins. This like all that credit contracted, and I always suspected, like, I was like, hey,
right,
how are you guys earning these these high interest rates? How are you earning money in crypto? Are you just like going and buying a lot, YOLOing into Dogecoin or something like that? And everybody was always like, oh, no, no, no. Oh, no. And then like the truth came out. Pretty much that's what they were all doing.
Yeah. Zeke, I had an offspring lose money in Doge. It's your fault. Okay, Zeke, let's cut to the chase here. You did history at Cornell, which is a great parchment, and you understand the perspective here. I want you to look forward with Bitcoin. You've got Ruin coming out on Bloomberg Originals. SBF is distracted, to say the least. BlackRock and other entities want to do an ETF. It's not the Doge, but it's Bitcoin. What's your response to the forward view of securitizing Bitcoin for the public?
I think that in the end, any company, any coin, its value has to come from it having use in the real world. And at this point, Bitcoin is as old as Uber, it's as old as WhatsApp. And ask yourself, have you ever used Bitcoin for anything? Do you know anybody who's ever used Bitcoin for anything? So I'm not optimistic that people are going to adopt it as some sort of replacement for gold when there's no real use of Bitcoin for transactions.
In piecing Ruin together for Bloomberg Originals, what was the biggest surprise in this narrative, in this story?
I mean, I think that the story is even, the more you look into the FTX story, just like the worse it looks. Like at first, SBF was trying to say, hey, it was just like a big mistake, right? And then I was pretty sure, hey, no, you made the decision to borrow your customer funds, that's fraud. And then the more we've looked into it, the more it started to seem like the fraud may have started even earlier than we thought. And at the trial, more and more has come out about how they defrauded lenders to Alameda, the affiliated hedge fund, or how they misled venture capitalists who invested in FTX.
And Zeke, we don't have a lot of time left, but Ruin's coming out. It's a great look at the past. Going forward with the trial, what do we have to expect here?
The prosecution has almost wrapped up their case. They may finish it tomorrow, and we don't know whether the defense is going to present a case at all. What I'm really curious about is whether Sam will take the stand. I mean, he loves to talk. He took every call from every reporter on the way up. And I just think it's hard to imagine he'll resist the chance to argue his case in front of this jury, especially because his lawyers don't seem to have been very convincing so far.
Zeke, congratulations on your book. It has made, folks, I can't say enough about the accolades Zeke Fox is, the movie rights, it's amazing what he's doing. I mean, I
think get those.
I think DiCaprio plays Zeke. I think that's what I'd look for. Zeke Fox with us here. And seriously, folks, this is extraordinary. It is hard hitting. It has ruined the fall of crypto exchange FTX and Sam Bankman-Fried. This is not some light gloss over. It's there. It's digital. It's out on YouTube and of course on Bloomberg as well. Look for that. And then tonight premieres 6 p.m. and of course through all the digital responses. Well, I didn't realize the court case is upon us.
Yeah.
Help me with that. It's like now.
Yeah, it kicked off a few weeks ago. It was expected to last about 6 weeks, and it's been pretty amazing to watch. I mean, you've seen
What's your observation?
I want to hear from Sam Bankman-Fried. We'll see if he takes the stand. We've heard from everyone else, it feels like, who was involved.
Yeah.
The only critique I would have is that cameras aren't allowed inside the courtroom, which would be very interesting to see. We've had to rely on these drawings of what's actually happening inside the room.
This is called old journalism. This is before your time, where actually there was a guy with a quill and he dipped it in the inkwell and they did drawings as well. So it's there.
Well, as a result, we actually haven't seen Sam Bankman-Fried. Of course, he has been in custody. So we've had photos of other witnesses walking in. We haven't seen Sam Bankman-Fried. Apparently, he's gotten a haircut. I would like to see it.
Oh, well, I'll have to see that. I get a haircut. It doesn't make news. Crypto. Catherine Greifeld and other worthies here at Bloomberg really giving you an update here. And, of course, this ginormous news driving BitDog up to 34,000. It's a bull market in Bitcoin. It's really been an abrupt move. I mean, are you surprised?
It's been parabolic. And I think when you look at the chart, the one-year chart, you look at the line straight up, it really shows you that this is a pretty illiquid market. The trading volume has just not been there.
She's busting my chops. She wants to get me in trouble here. She's going to ruin me. That's a joke. Ruin, get it?
Yeah.
Bloomberg Originals.
Documentary.
Ruin. See how I did that?
Yeah.
It's a nice Segui. Ruin tonight. Bloomberg Originals. Coming up on Bloomberg TV, Cristiano Amon, Qualcomm President and Chief Executive Officer. With futures red and green on the screen, let me give you the 10-year, 2.47% on the real yield. Stay with us. This is Bloomberg Surveillance.
Names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramos in for Jonathan Farrow. Is a little bit of softness to the market. Is it the Google effect? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, markets on edge, futures under pressure as earnings keep rolling in. A tale of two clouds, Alphabet and Microsoft delivering mixed results. And House of Cards, Republicans floating yet another name to be the next speaker. We begin with the big issue, earnings season ramping up.
This is an incredibly important week from an earnings perspective.
The magnificence of the big cap tech names.
Front and center is all about the cloud. Business of Microsoft did very well, whereas it disappointed in Alphabet.
I am a little bit cautious on these tech earnings going through.
Year-to-date returns have been really good.
Meta obviously is one that you want to watch very, very closely.
If you think about the tech group as a whole, AI has been a big driver.
They're sensitive to the AI data points.
It's not so much what's happened, but for me, it's those outlook statements on what consumers are going to be doing.
It's absolutely about the guidance.
Really, the question is looking ahead.
When you think about future stock upside from here, we are very much focused on that earnings picture.
We're going to be counting on big cap tech and communications to do the heavy lifting. It's absolutely critical whether the big seven do continue to produce the earnings growth the market's expecting.
Joining us now to discuss is Hightower's Patrick Frazzetti and Zachary Griffiths of Credit Search. Patrick, I want to start with you. How much are we actually getting some sort of narrative from these earnings versus a stock-by-stock, story-by-story type of micro picture that people used to know before, say, 2007?
Yeah, well, I think when you look at tech earnings particularly, I mean, as tech goes, so goes the market. We've seen that this year. We've seen that out of the large 7 tech stocks. I mean, price to earnings ratios now close to 45. I mean, that's up from the high 20s earlier in the year. If you compare that to the rest of the S&P 500, no, it's actually the rest of the S&P 500 is reasonably priced in the high teens. So what we're looking for with some of these tech earnings, of course, they're mixed. You know, Microsoft is pretty solid. We saw some growth in Asia and cloud, and Google was really the opposite. So we'll see how the rest of these come out as the week goes on. We certainly got a slew of bank earnings last week, and we can talk about that in a bit as well.
Well, but Patrick and Zach, weigh in here, because as we're looking at the fundamentals, it has to do with the wherewithal to pay back debt, the wherewithal to maintain cash flow at a time where the consumer is still strong. From the earnings that we have gotten so far, and it is still in the beginning throes of earnings season, Zachary, how solid have some of these balance sheets looked?
Yeah, Lisa, when we look at balance sheets in aggregate, really across investment grade and high yield companies, you really haven't seen the bite of higher rates just yet. Management teams have done a pretty good job of pushing out maturities, and so that's something that we're definitely focused on in 2024 as a reason to see some deterioration in fundamentals. But from a consumer spending perspective and the strength of the consumer that we've seen, we're really not seeing that deterioration in balance sheets. Even interest coverage that's come down a bit from recent highs hasn't really tumbled off a cliff. And so when we think about the fundamental picture in 2024, we still think it's solid, as we're not looking for the economy to roll over into a recession.
Patrick, you said something earlier that where tech stocks go, so too goes the entire S&P. At what point are you starting to see a breaking apart of that kind of idea when you do get the likes of Microsoft and Alphabet or Google report such different earnings pictures?
Yeah, well, look, if the market, was able to sort of digest that and differentiate between these earnings, that would be a good thing. I just don't think where some of these companies are priced, it's reflecting that just yet. But like I said, there are 493 other companies. We look at those individually. There are certainly some interesting companies and sectors out there today that are reasonably priced. And so, if we start to see that differentiation, good. I think we should. In a higher interest rate environment, you should begin to see that. As Zach mentioned, when you think about, corporate credit and some of these companies have termed out their debt longer, that's great. I mean, that's a good sign. But we'll continue to see, which companies are pressured. I mean, this won't be, the last quarter where we see this. We'll begin to follow this narrative, in the coming quarters.
Patrick, right now, from what you've seen, are you getting more bullish or less bullish?
I'll tell you one thing. I'll just talk about bank stocks for a second. We're 6 months removed or 7 months removed from, what was really a banking crisis. And you started to see regional banks, banks overall, just back to their March lows. And I just don't think you can have a healthy economy, a healthy market without a healthy banking system. It doesn't mean that we're seeing defaults or anything like that. I just want to, you saw in the Journal this morning, some of these regional banks that reported, commercial and industrial lending is down. And so if we start to see that improve, then I'd become more bullish. That's what I would say.
Zach, just picking up on Patrick's point there where he was talking about how a lot of companies are paying down debt, not incurring new debt. How much is this technically what's underpinning the credit market, given the fact that there just isn't going to be that much issuance at rates that are the highest going back to before the last financial crisis?
We do think that's important from both a technical and fundamental perspective. And one of the things that we've been discussing with clients in meetings recently is that management teams are going to be more responsible going into next year. You're not going to see this intentional re-leveraging that we've seen in the past that can lead to problems down the road, especially as rates are higher and you've had decompression in terms of borrowing rates across different rating sectors. And so you certainly want to protect your investment grade rating, whereas in the past cycle, in that expansion where interest rates were so low, you really didn't get penalized to move down the rating structure. And so that allowed for more leverage to come into the system. So we're not expecting that. And we think that is a tailwind for corporate credit in 2024 when we think about the fundamental perspective, and will only be slightly counterbalanced by the higher borrowing costs that will have to be realized.
Well, how much do you then see, Zach, a divergence right now between investment grade and high yield widening dramatically in response to what you were just saying?
Yeah, we think the move in high yield has been interesting, and we thought that spreads had been more resilient over the past couple of months with the move higher in rates really across the Treasury curve. And so we are looking for continued near-term caution with respect to our recommendation on high yield credit. But if we get back toward that 500 basis point spread level, we think when you think about all-in yields, that's an attractive point to get back in, as we are looking for economic growth to remain positive and financial markets to remain functioning nicely in 2024.
Speaking of economic growth, from earnings over to the data, investors looking ahead to fresh GDP figures as the Fed goes quiet this week, mostly. Bloomberg's Michael McKee joining us now with a preview. Hey, Mike, welcome back.
Thanks. It's going to be fun tomorrow, Lisa, when we get the numbers at 8:30, because the predictions are for a very strong growth figure, but some have it even stronger than the Bloomberg consensus of 4.5%, which would still be the biggest since 2019 if you leave out the pandemic years. Personal income and spending and the PCE inflation numbers then follow on Friday. So we've got 2 big days of numbers that probably won't, but could influence the Fed next week. But it's definitely something the markets are going to be taking into account. Now, here's why everybody is going to be watching GDP and the strength in GDP so closely. I took out the pandemic years basically because they throw every chart off. But if you look at this closely, you'll see that every time the Fed is raising rates, GDP is falling, except for now. And why is that? We don't know. And so does that mean the Fed is going to have to do more? Or does that mean that inflation is going to continue to come down just because this is a weird time? That's going to be the question of the day, debated at 8:31 tomorrow. And then the question going forward is, what does it mean, as I said, for the Fed here and Jamie Dimon and those who are concerned about what happens next year? That's the dot plot from September, and you can see how wide the dispersion is. But basically, the lines that count are the white and blue lines. White is what the Fed thinks, at least in September, thought was going to happen, and blue is what the market thinks is going to happen to the Fed funds rate in 2024. And it'll be interesting to see how that market perception changes after we get these next 2 days of numbers.
Michael McKee, thank you so much, and welcome back. Mike was saying this is a weird time, and I want to pick up on that. Patrick Frazzetti and Zach Griffiths still with us. Patrick, from your perspective, is this time different? We keep hearing that normally when yields get to 5%, things break. Normally when you end up with this type of hiking cycle, GDP goes down. It is accelerating. What makes this time different?
Well, I don't know if it's different, but I'll tell you what is different is an extremely tight labor market, right? So we've seen, I think inflation has become very sticky, and I think it'll continue to do so. Just look, you see every day headlines about a strike and whether it's been averted or whether it's continuing. Obviously, we've seen it in all industries. And so I think that is different. So you have a tighter labor market. And so, you don't necessarily see the same direct impact yet on the economy. But, with higher interest rates, it's harder to borrow, it's harder to buy a home, it's harder to buy a car. And, the returns on a project, if you're a company and you're looking to invest, have to be, pretty good. I mean, you're borrowing at probably 9 or 10%. So I think, we're not out of the woods by any stretch. We have to carry this thing forward. I think there's a little bit of a lag effect, and we'll see, where we are throughout the first half of 2024.
Zach, where are you on this? We were just speaking with Jim Bianco from Bianco Research, and he was saying what we've seen is just the amount of savings. The economic shock of 2020 has been enough that actually 5% Fed funds rates is the normal, is the base of what it needs to be, and everything can keep accelerating from here.
Well, Lisa, with what we've seen in terms of economic activity, it's easy to make that argument. But I think the lagged effect of the tightening that we've seen over the past 18 months has yet to be felt. And when we look ahead, we do think you can see inflation continuing to come down. You have student loan repayments starting this month. You have commercial banks tightening credit. We think there are some pretty clear disinflationary signals that are going to play into 2024. And so when we think about it being a weird time, we do think that economic growth has been more resilient, but inflation can continue to come down as we're still seeing some of the supply side problems that we had over the past couple of years come out of those numbers. And so while economic activity is going to have to downshift for inflation to get back toward that 2% target, we think there are enough factors lining up in 2024 to provide that. And when you think about what's really driven the U.S. economy, it's been this services spending. And we think as excess savings come down and are potentially completely eliminated by the end of this year and the unemployment rate starts to rise, that really comes off and you see GDP come off the boil.
So at this point, are you talking about basically we can avoid some sort of recession and still get disinflation enough to bring us back to the Fed's target, Zach?
That's our base case, and that's certainly been a hard argument to make when you look at past tightening cycles and how that's all unfolded. But we do think all of the tailwinds that we had from fiscal and monetary stimulus over the past couple of years has finally worked its way through the system, or is at least close to that point. And so I think that why people have been so surprised with how strong economic growth has been, some of those drivers are coming off, and you're going to have to see some of these more traditional factors that play into economic growth have a larger impact in 2024, but not so much so that the economy completely falls off a cliff.
Patrick Frazzetti, Zachary Griffiths, both of you are sticking with us. Let's take a look right now at some of the stocks moving ahead of the opening bell. Abigail Doolittle with us. Abby.
Well, Lisa, as you said before, we have a tale of two stories between the cloud, or in the cloud, between Microsoft and Alphabet. Markets overall seem to be siding with Alphabet with that little bit of a soft tone. But take a look at Microsoft, popping 4.7%. Revenue overall up 13%, better than a year ago. And the cloud, a bit of a relief, up 29% and above the growth for the three preceding quarters, even though it's missing on a year-over-year basis. Alphabet down 6.1%. Now, they put up revenue that grew 11% to $77 billion, but that cloud growth slowing to 22%, or about $8.4 billion. Investors disappointed in that. And then finally, Boeing up 3.6%. They missed earnings by 10%. You wouldn't think the stock would be up, Lisa, but they maintained the free cash flow outlook for the rest of the year. They also talked about double digits by mid-decades, and they kept their delivery target for the 787 wide-body. Investors liking that, sending the shares of Boeing higher ahead of the open.
Interesting. Abigail, thank you. Meanwhile, coming up, the drama in D.C. continues.
What we need to do really is come together as a party. We're going to have our differences, but we have to understand that the real differences we have are between Republican and Democrat.
House Republicans picking their fourth speaker nominee with a floor vote expected at noon. That conversation coming up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Sadly enough, we've gone through many individuals. I did not personally think McCarthy needed to be taken out. There's an absolute urgency to get this done and actually get back to passing appropriations bills, getting back to appropriating money where it needs to be for the country. But again, you know, we have some folks that are at no, begin at no, and want to move, and we're trying to get them to move to yes. What we need to do really is come together as a party.
It's another chapter in the speakership saga, with the GOP hoping for a conclusion, finally. Congressman Mike Johnson of Louisiana becoming the party's fourth nominee in 3 weeks. The House expected to hold its next floor vote at noon Eastern. Johnson receiving support from former President Donald Trump, posting online, quote, "I'm not going to make an endorsement in this race. ... My strong suggestion is to go with the leading candidate, Mike Johnson." Bloomberg's Kaylee Lyons joining us now. Kaylee, isn't that an endorsement?
Well, maybe not in so many words, Lisa, but remember, Donald Trump did help sink Tom Emmer's bid yesterday for the speakership. He only lasted as the speaker nominee for about 4 hours and 10 minutes after Trump said that it would be basically saying that it would be a mistake to elect him speaker. So we'll see if the fate of Mike Johnson is different after Donald Trump came out and at least suggested that those in the Republican conference should support him. Now, in the Republican conference meeting last night, when he secured the nomination, they then took a roll call vote in which Congressman Michael McCaul described almost unanimous support for Mike Johnson. Only 3 voted present rather than voting for him. There were a handful of absences, so we don't know exactly what the math will look like on the floor come noon today, but there is a feeling in Washington this morning that he might stand a better chance of actually getting 217 votes and getting the gavel than those who tried before him. Not just Tom Emmer, but of course also Jim Jordan and Steve Scalise. There is the fact that he does appeal more to the harder right flank of the Republican Party in the House, considering he did support Trump's efforts to overturn the 2020 election result, but he also just hasn't been around that long in which he could have built up enemies internally. He was first elected in 2016. Yes, he chaired the Republican Study Committee, but he doesn't have that much leadership experience. And while that could work in his favor in actually getting the gavel, it might work, or it could be a challenge for him going forward if he does indeed become speaker and then immediately has to be put in a room with Chuck Schumer and Mitch McConnell, Hakeem Jeffries, maybe even President Biden, as they all are going to have to work together to figure out a way to continue to fund the U.S. government past the deadline of November 17th. So if he gets the gavel today, and that very much is still an if, we'll find out this afternoon, he definitely has his work cut out for him going forward, Lisa.
Kayleigh, when you walk the halls of Congress, what do you feel more of, frustration or urgency?
There's been a little bit of both, I would say, as time has gone on, considering we are now day 22 without a speaker and we've run through a series of candidates. There is growing frustration, but there also is a growing sense of urgency because the more days it takes to elect a speaker, the closer we get to the government running out of funding. And of course, there's also the Israel challenge laid on top of that with the supplemental request from the White House and a need to address that congressionally. And you need a functioning House to do that. So I think everybody's kind of reaching a breaking point here, Lisa.
Kayleigh Lyons, thank you so much. Still with us is Patrick Frizzetti and Zachary Griffiths. Zach, from your perspective, how much is some of the dysfunction in D.C. part of what's behind the lift that we're seeing continue today in yields?
Lisa, I think it's certainly a factor. It's hard to quantify, but when you think about rising deficits or rising financing needs at the Treasury, and we're going to find out more about what exactly that looks like at next week's refunding, which was a big driver of the move that we had higher in August, it's certainly playing into it at the margin. And I think that the longer that this goes on, the more that you can expect Treasury yields to rise or remain under pressure in the near term, and for investors to have their mindset shifted from a longer run perspective into the safety of U.S. Treasuries. I think it's a terrible development that this continues to go on, and is certainly going to have an impact on borrowing costs in the U.S., and I think we're already seeing that.
Well, and Patrick, this sort of feeds into some of the angst around next week's refinancing announcement. We get a sense of just how much bigger some of these auctions are going to be that come out periodically from the U.S. Treasury Department. How worried are you? How closely are you watching the reaction in markets to understand if yields are going to break higher or lower?
Well, we're watching it very closely. Quite simply, I would say the market doesn't like uncertainty, and they don't like, dysfunction. And to say, Washington is dysfunctional is an understatement. So yes, we follow rates very closely, and I do think they are, a predictor of things to come. So we'll see how it goes next week.
Patrick, do you think that changes your view when it comes to risk? If you see yields going higher as a result of dysfunction and deficits, which is new for the United States, usually people had actually talked about higher debt loads in the developed markets leading to lower yields. This is a new paradigm. How much does that make you less willing to go and to lean really heavily into risk longer term?
Yeah, well, it's still a concern. So I would say, I think, leading into this, if you haven't positioned appropriately, I mean, this has been a concern for many, many months now. And so, we've positioned accordingly where we have a little bit more, liquidity. We had kept duration very short for 18 months. We can begin to possibly extend that a little bit longer, but overall, it's still pretty short and taking advantage of higher interest rates. And then on the equity side, like I said, there's still value to be had, no question, in different sectors. I think we're avoiding some of the things that look a little pricier or speculative, as we go throughout this earnings season. But yes, it's certainly a concern. And as I can just reiterate, the market doesn't like uncertainty, but that can lead to some opportunity, no question.
Zach, CFOs don't like uncertainty either. Are the CFOs that you talk with, that you analyze, understanding that these 5% yields for over the 10 years really might be the new reality?
I think there's a lot of concern around that. And when we think about what's really shaped where yields head directionally and the shape of the curve in the past, a shift in monetary policy tenor, and so a turning point in the Fed cycle, if that were to come to pass early next year, has historically had a larger impact on where yields go in the shape of the curve. If you look at the past 6 tightening cycles and the 3 months after the last hike, which we think was in July, yields have moved lower on the order of 75 basis points on average in the 2-year and 10-year. And so this move recently has really gone in contrast to what you'd expect if the monetary policy tightening cycle is in fact done, which is certainly up for debate. And I think part of that has to do with the supply story and all of this uncertainty. So when we look ahead to next week, we do think Treasury is able to downshift, at least with respect to the pace of auction increases, especially as you've seen auctions come up so much. And so when we think about How that shapes where yields go for now, we think the path of least resistance is higher going forward.
Unfortunately, we've got to leave it there. Patrick Frizzetti, Zach Griffiths, both of you, thank you. Coming up, the morning calls. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Look at some of the analyst recommendations this morning. First out, Wells Fargo upgrading the gap to overweight, highlighting recent turnaround efforts and cost control measures. Next up, Piper Sandler downgrading Regions Financial to neutral, moving to the sidelines after lackluster results. And finally, Citigroup downgrading Etsy to neutral, seeing limited visibility into next year. Coming up, the opening bell, we've got RBC's Amy Wu Silverman and Dan Salmon of New Street Research.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
This is Daybreak Europe. I'm Preeti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow, just moments away from the start of trading at a time where everyone is watching for some sort of earnings understanding of the picture. We get, of course, more after the bell. 0.4% decline on the S&P. NASDAQ down 3/4 of a decline. How much is this the Google effect? Outside of bonds, you can take a look at yields. They are climbing, so that is retreating in terms of price, and that really might be underpinning some of the anxiety. 10-year yields 4.89%, still 11 basis points away from that 5% threshold. Dollar strength, euro weakness after those negative PMIs yesterday, positive U.S. data, and crude prices basically waffling around, trying to find a bid in the uncertainties, the vagaries, and the geopolitical issues that have arisen. One stock to watch at the opening bell, Alphabet. Its cloud unit reporting a smaller than expected profit. The CEO shifting the discussion towards artificial intelligence, saying, quote, "We're continuing to focus on making AI more helpful for everyone while making exciting progress with lots more to come." Didn't talk about the cloud, and that's where all of the equity investors have been focused on. Ed Ludlow has more. Ed.
Yeah, good morning, Lisa. This is a big move lower by Alphabet, the parent of Google, down 8%. That puts it on track for its biggest drop since October of 2022. The story is really clear. A miss on the top and bottom line for cloud, but a pretty significant beat across the board on all other metrics. And the cloud story is interesting. Sales of $8.41 billion, below street estimates of $8.6 billion. Operating income in the unit of $266 million, below operating income estimates of $434 million. When I spoke to Ruth Porat, who is now the President, Chief Investment Officer, and CFO of the company, she called this customer cost optimization, which is cloud speak for customers cutting back on their cloud spend. You highlighted what Sundar Pichai had to say about the AI story, and when I asked Ruth Porat if they were able to add new customers in the quarter because of generative AI, she describes what they call a backlog across all AI applications, but no data that would kind of support forward-looking growth specifically for the cloud. We saw resilience and stabilization in search for Google and also ads for YouTube, but it basically isn't enough. And at the center of this story is the idea that Google Cloud is a distant third behind Amazon AWS and Microsoft Azure, which you're just about to hear about being the opposite story. And even though there is resilience in its sort of legacy ad business, it's going to be the growth in cloud that comes as a result of AI investment, and there wasn't really enough to get that over the line. Some analysts have cut price targets, some analysts have actually raised price targets, but all of them agree that it's kind of evidence that we're not yet seeing the effect of spend to power generative AI just yet, at least in Google's context.
Ed, thank you so much for that. More positive outcome for Microsoft, as you were mentioning, Ed. Talking about the strength of its cloud business and AI demand, the CEO saying, quote, "We're rapidly infusing AI across every layer of the tech stack to drive productivity gains for our customers." It sounds great, but everyone was also focused just on the fact that Azure came out with incredible results. Isabel Lee has more. Isabel.
Hey, Lisa, Microsoft was indeed a talk of the town, and for a good reason. The three business segments of the company, which is productivity, intelligent cloud, and personal computing, all had beats and all beat their estimates. Shares are on track if gains hold right now, and they're popping by almost 4%. We will see the biggest gain in 3 months. So the optimism is really largely because of its cloud business by Azure. Company strong sales are coming in at $56.3 billion. The company was also boosted by its investments into AI. It poured around $13 billion into the firm behind ChatGPT. And this makes one wonder, did
investors really underestimate the cloud story amid all this AI frenzy. Amazon is still the leader in this area, though, and it reports on Thursday. But for now, for Microsoft, revenue in the first fiscal quarter rose 13%. So this is the most in 6 quarters, and it topped all analyst expectations. Profit was $2.99 a share. And as for Azure, we saw that the sales gained 29% versus 26% in the previous quarter. So analysts say if we see stabilization, then the euphoria will continue. And analysts also say that overall, yes, the cloud business did lift up everything, but it was a broad-based gain. So good day for Microsoft, indeed, and shares are now up by 4%, Lisa.
Isabel, thank you so much. It's good news and bad news for Boeing as it reiterated its yearly cash flow forecast, but lowered its annual target for 737 aircraft deliveries. CEO saying, quote, when we set our recovery plans, we knew issues would come up along the way. This is a complex, long-cycle business, and enduring change takes time. Joining with more is Abigail Doolittle. Abby.
Well, Lisa, good news, bad news story indeed. It's a real stop-and-start recovery out of the pandemic, and one interesting point is the fact that this company has now put up its 9th consecutive loss in a row. This one wider than expected, missing the estimate by about 10%. The 737 production missing the mark as well. But to the upside, as you were talking about, they've maintained the free cash flow outlook for this year. They are keeping the goal of $3 billion to $5 billion in free cash flow. They've also kept their mid-decade targets, and offsetting that 737 weakness is the 787 wide body. The production targets there are looking pretty solid. Now, for the 737, they guided down to 38 jets per month. They're hoping that will increase by the end of the year. For the 787, that bigger plane, they're looking at 10 jets per month. One analyst of Vertical Research Partners is saying that they are hanging on by their fingernails, maintaining this free cash flow. The stock really reflecting that at this point, up 1.9% on the year, though, Lisa. This stock basically flat, reflecting the frustration that investors have about this good news, bad news story for Boeing.
Abby, thank you so much. Turning back to tech, Snap delivering revenue growth in the 3rd quarter after 2 periods of declines. The CEO is saying, quote, we're focused on improving our advertising platform to drive a higher return on investment. Simone Foxman has more. Simone.
Yeah, Lisa, this stock has been all over the place, not just since the company reported earnings. In the post-market, it was up about 24% before reversing all of those gains pretty much. Now we're looking at shares up 3%. They had been up about 8%. And really, analysts trying to figure out what to make of all the mixed messages here. The financials were pretty positive. They returned to revenue growth in the 3rd quarter following 2 periods of declines, a net loss that came in lighter than anticipated. But the company also saying that it actually could be hurt by the impact of the war in Israel and Gaza. Brands slowing their advertising campaigns, putting them on pause since the start of the war. And the company says that could continue into the 4th quarter, making the outlook for that quarter very difficult to determine. In fact, saying that it would be imprudent to provide a formal outlook. The company's in a year into an overhaul of its business. Its Snapchat Plus revenue service or subscription service has been pretty positive, as has users' engagement with an AI chatbot. But analysts, despite the fact that they're pointing to some of these positive 3Q numbers, seeing a difficult outlook on long-term. Vital Knowledge saying results okay, but the company is a minnow in the online advertising space to the likes of Meta, Alphabet, TikTok. And it's hard to see how that changes in the future, Lisa.
Simone, thank you so much. Sticking with tech, New Street's Dan Salmon weighing in on Alphabet's results, writing, quote, disappointment in cloud revenue growth arrived at Google. We'd expected this will be the number1 controversy for the stock going forward. Dan joins us now. Has a buy rating on the stock and a price target of $160. Right now, it's below $130, $127 a share, with the biggest share drop going back more than a year. What's your view? How can you be positive on a stock where people don't necessarily see the cloud growth that they need to keep the money flowing in now ahead of AI?
Yeah. I think today's reaction obviously is mostly about where the 3rd quarter number came in. It was below expectations. They decelerated a little bit more than what everybody was expecting. Where I think the conversation goes to, and your reporters hinted at it as well earlier, was, we saw Microsoft see a slight acceleration in their cloud business owing to AI. So they're clearly the ascendant one grabbing share here. I think what that's going to do is reinforce this narrative that Microsoft, in partnership with OpenAI and ChatGPT, have the momentum right now in AI. The reason that we're confident coming down saying that this is a buying opportunity is if we look ahead, we know that Alphabet is going to be releasing their new large language model, Gemini, coming up soon, hopefully before year end. And that we think will be a big catalyst for the stock.
So, Dan, how are you getting confidence that you are going to see that kind of growth in AI that will translate into revenues in the near term that can keep a price target that indicates a pretty significant rally after an already significant rally so far this year?
Well, I'm glad you mentioned that. I mean, look, the setup for Alphabet going into the quarter was a little bit difficult as they've been an outperformer of late. So expectations were pretty high, and this is a little bit of a reset on that today. Look, we'd go back to what, Sundar Pichai reminds everyone on a regular basis is that Google raised AI to be the #1 priority at their company 7 years ago. We don't think there's any company out there that has invested more in a full stack, including their own proprietary infrastructure, the cloud platform, and otherwise. But no, they are chasing Microsoft a little bit here right now. We're confident that they can get that back online. The other thing that mentioned earlier as well is the ad business is going well. The search business outperformed. That is still the engine of profitability for the company. We think they're benefiting from a strong e-commerce market, especially some incremental advertisers like Temu and Shein from the Chinese market. So that's still the engine of profitability. But we think, like I said, if we look ahead to the launch of Gemini, there's a big potential catalyst coming for Alphabet that we think can reinvigorate investor sentiment.
I'm glad that you mentioned advertising, and that's something that's a very big question, especially after our own Simone Foxman just went over how Snap has potentially some hangups in that area in terms of how much they can grab on that. We get after the bell today, Meta or Facebook. How much do you think that the positive advertising trends that you saw in Google, Alphabet, will be continued through Facebook or Meta at a time of really shifting demands and clear consumer preference for no advertising?
So the first part, of course, where current ad trends are going to be based on is where demand is from advertisers right now, and similar to Google highlighting strength in e-commerce for supporting their search business. That's the biggest category for Facebook's advertising, Facebook and Instagram or Meta. So I think the near-term trends for that are going to be very solid for Meta. And we've seen them continue to rebound throughout this year after taking it on the chin like Snap from some of Apple's privacy changes last year. To your point on consumers' preferences shifting away from ad support, generally most consumer media platforms have always offered some options of ad support versus not. HBO was out there for years as the network without advertising. You mentioned Snapchat Plus, which is Snap's subscription service. They're also slowly but surely rolling out an ad-free version of it. That's the opportunity for social media companies, is to diversify their revenues and establish ad-free subscription services. That's something we've seen reports on coming from Meta potentially and partially as a reaction to some of the restrictions that we're seeing in Europe on what they can do with their ad business.
So just real quick, Dan, do you think that we're going to get a positive surprise tonight for Meta?
I think the results will be good. I think they're expected to be good. So ultimately, it'll be, are they good enough, relative to expectations? We have a buy rating on it, especially getting a little bit of pullback in sympathy with Google here tonight. Right now, which again is really about the cloud business. That's not relevant for Meta. It's all about the ad business, and I'd expect them to be strong.
Dan Salmon, thank you so much for being with us. Coming up, geopolitics keeping markets on edge. That conversation up next with Amy Wu Silverman of RBC Capital.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What needs to be done right now is to deal with the context as it is in this particular moment, obviously with sensitivity towards the grievances, but with a recognition that Israel has a right to defend itself, that there is a severe humanitarian crisis in Gaza, and that there is an effort to get humanitarianism in.
Diplomatic efforts to avert a wider Middle East conflict intensifying as Qatar hints at breakthroughs in hostage release negotiations with Hamas. The U.S. pressing Gulf allies to help clamp down on a suspected increase in fundraising for Hamas, calling a special meeting to prevent more deadly attacks. A Treasury official saying, quote, "This moment should bring a profound sense of urgency, clarity, and purpose to the work that we do. The ability to act to cut off the financial flows that feed terrorism is a duty we all share." Joining us now is the one and only Anne-Marie Herdern in Washington, D.C. Anne-Marie, starting there, we also heard about a conversation through the Saudi prince, Mohammed bin Salman, and President Biden, which is highly unusual. What's the latest in the U.S.'s attempt to stave off a regional conflict?
Yeah, it's very unusual. Remember, this was an individual that President Biden, when he was campaigning, said he wanted to make a pariah. Now the U.S. really sees Saudi Arabia as an ally in the region, and especially when it comes to this conflict, because the United States is continuing their frenetic diplomacy, as are other world leaders, because what world leaders want to make sure is that this conflict stays isolated within Israel and Gaza. They do not want to see this widening and spreading. So not only did we have that phone call yesterday between President Biden and Mohammed bin Salman, but also we have Emmanuel Macron, who's leaving Israel, visiting Egypt today. We have the Austrian chancellor going to Israel. We have the Czech prime minister going to Israel. So you can see this flurry of diplomacy is not stopping. This is top of mind of world leaders. They want to make sure that they can contain this crisis. And of course, we heard from the Qatari foreign minister, they seem to be making headway when it comes to hostages. That seems to be a main focus as well for global leaders.
How much is Israel listening to Biden when it comes to all of this? Is Biden directly talking with the Israeli government to try to maneuver in all of this?
Well, of course, we have President Biden holding a number of phone calls since the October 7th massacre with his counterpart, Benjamin Netanyahu. He obviously made that trip there. And then U.S. officials are talking to their counterparts. Publicly, U.S. officials will say they are offering intelligence. Obviously, the U.S. is standing shoulder to shoulder with Israel. They've made that clear. But what we have reported is that European and U.S. officials have been pressuring Israel to slow down any ground invasion until they could potentially make headway when it comes to hostages. When President Biden was asked about a ceasefire, he said, we need to get those hostages out first, then come talk to me.
Anne-Marie, thank you so much. Oil prices remaining grounded as the Israel-Hamas war remains contained, at least for now. Brent oil flirting with a fourth day of declines after giving up roughly half of its Middle East risk premium. Bloomberg's Abigail Doolittle has more. Abby?
Yeah, there's been a tremendous amount of volatility for oil recently, but it's not just over the last few weeks around this Israel-Hamas war, Lisa. It is all year. Oil has been whipsawing up and down on various demand and supply outputs. Now, over the most of the summer, oil had actually climbed by as much as 40% from its year-to-date low to the peak. And the story there was that the OPEC plus production supply cuts, that they were keeping oil in check. And then we, of course, had that sudden decline back below 90 toward 80. And then on the conflict, we, of course, had not just oil, but the entire energy complex really rally on the idea that there could be supply shortages. One of the biggest mover on the conflict, Lisa, of course, was European natural gas, at one point up 30 to 40% in just a few days. And then, of course, as Chevron shut down one of their natural gas offshore drilling rigs. Oil right now, though, Lisa, back below $85, technically breaking down. It looks as though we could see a big directional move either way, slightly more skewed toward the downside, maybe toward 70 soon, Lisa.
Abby, thank you so much. Joining us now is RBC's Amy Wu Silverman. And Amy, we talked earlier when this conflict first erupted about how exactly nervous traders were, how much they were hedging against potential tails. Have those tails been taken off? Are people less nervous in the trades that you observe?
So, you know, what's funny, Lisa, is I don't know that I would tell you that the tails were ever placed. This has been very interesting to watch. It's obviously been such a severe human toll. But 2 weeks ago when this happened, you actually saw relatively muted action coming out of the options market. That increased a little, but really not by that much when you look at other historical conflicts, Russia-Ukraine, for instance, where you actually got a VIX headline peak of nearly 40. We just never got close to there. We've always stayed under 20 on that headline VIX, and those tails still remain kind of near historical kind of 5-year lows despite the ongoing volatility.
Are you surprised by the complacency, given how some people have been saying some of these tails are fairly cheap?
Yeah, and I guess I would add that I'm one of the people saying that these tails are fairly cheap. Look, I think the market to some degree, there are some technical reasons why overall we've seen muted index volatility. There's been a dramatic amount of volatility selling programs in our space. There's been dispersion in our market. A good example is just what happened overnight with Microsoft and Google. Look, when those two big index weights move in different directions, what does that do to the NASDAQ? It kind of keeps it balanced. We've been suffering from that paddling duck situation in the market for a while, and that dispersion is implementing changes in correlation to our market, which keeps it muted. But again, I do think we are a little bit complacent. We also have no Speaker of the House. I think there are a lot of event risk items out there that could drive a bit on the index level.
Do you think that that actually is a potential event risk? Because a lot of people have gotten used to shrugging that off too. Washington dysfunction, what else is new?
Yeah, no, that's a totally fair point. And, you know, I always point back to 2011, where when we had that initial debt ceiling crisis, we went to a VIX of almost 45 and we stayed around 30 for the remainder of that year. I think we've been trained since April of this year to say, look, this is kind of a non-event. It's been can-kicked. That said, it is a little bit unprecedented to not have a speaker, and we still have other ongoing strike issues. So, look, I don't think you can just say, you know, been there, done that, seen this movie. I do think it's slightly different.
If we do get some sort of stability in the bond market, do you think that the ammunition under the hood is there to really stage a rally?
I definitely think that's possible. So, look, at the end of the day, what is driving equities, that rate narrative has been such a huge component of it. I will tell you, the way that positioning is right now is extremely different than it was 4 months ago. So if you look to the single stock side or the index side, just that positive headwind where that momentum begot momentum on the big mega cap tech names, that is all but gone. And so if people need to do that chase very quickly, I think we could get into a position where folks were offsides and then they have to do that tailwind catch up, which is something that we saw in NVIDIA during the first earnings cycle.
Amy Wu-Silverman, thank you so much for being with us. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Trading Diary you need to be watching this week. The House planning to hold another speakership vote this afternoon. Meta earnings coming after the closing bell. Amazon reporting on Thursday. Plus, we'll get an ECB rate decision and U.S. GDP. And on Friday, earnings from ExxonMobil and Chevron at a time when there is a great consolidation, a great roll-up in the shale space. From New York, this was Countdown to the Open. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Anna Wong, Chief U.S. Economist with Bloomberg Economics. We got a lot of eco data today. I want to see how that works into her model. Joe Lemington, Director of Credit Research at Bloomberg Intelligence. He's going to join us to talk about the auto companies, their balance sheets, and this auto strike here. I might even ask him a question about GE and some other industrial companies, too, because he covers all that as well. Angelo Zeno, Senior Industry Analyst at CFRA Research. He's going to join us to talk about those tech earnings we had last night. And we got some more tech earnings after the close today, so we'll talk all things tech. But first, let's kick off this hour with a little Bloomberg Business Flash. Nathan Hager.
Yeah, add this to the economic data discussion with Anna Wong. Just got some new home sales figures for the month of September. Big upside surprise at an annual rate of 759,000. Average economist was expecting 680,000. So apparently people are still buying new homes, even with interest rates at near record levels or historically high levels, near 8%. As for the market, it is moving lower with big tech earnings in focus. The S&P is down 1% or 43 points, 4204, right around 4,200 for the S&P level. The Dow is down 0.4% at 33,018, and the NASDAQ is lower by 1.5%, a drop of 188 points, 12,950. Mixed cloud results for Microsoft on the upside, Google parent Alphabet on the downside. Patrick Frizzetti is portfolio manager at Rose Advisors.
As tech goes, so goes the market. We've seen that this year. We've seen that out of the large 7 tech stocks. I mean, price to earnings ratios now close to 45. I mean, that's up from the high 20s earlier in the year. If you compare that to the rest of the S&P 500, no, it's actually the rest of the S&P 500 is reasonably priced in the high teens.
The Alphabet shares are down 8.5% right now, close to a year decline, while Microsoft shares are higher by 3.7%. 10-year Treasury is down 19/30 seconds for a yield of 4.90%. The 2-year yield 5.09. NYMEX crude is down 0.1% at $83.61 per barrel. COMEX gold up 0.4%, $19.94.10 per ounce. Euro 1.0574 against the dollar. The yen is at 149.93. Going to sneak in this red headline just across the Bloomberg terminal. Apple is raising the price of its TV Plus service from $6.99 a month to $9.99 a month, joining the streamers that are raising their rates.
I'll pay it too.
Apple shares are now lower by 1.2%. That's a Bloomberg Business Flash. Bloomberg Markets is on. Paul Sweeney, Matt Miller.
It's worth it.
Yeah, I don't know.
I
Who knows what's
I
worth
think
it?
it's worth it. I don't know. Like, there's so many. I have so many services with Apple, Netflix, Prime, Hulu, Disney, HBO that I don't know anymore which one of them has good shows because I just go through, the gamut every night, and
I don't know. You add them all up, it's my cable bill from 2 or 3 or 4 years.
Exactly.
Ago. Exact same thing. It's a total scam. I like the old model. The old model worked fine. Everybody made money.
Well, except for nothing was on back then. You have to admit that the content is about a billion times better.
Yeah, they're spending. I mean, the content spend out of Hollywood is like, I'm just going to swag a number here, $50-60 billion a year, and that's up 3-4x from maybe 10 years ago. So they're making a lot more stuff, a lot more quality stuff. It's just hard to find. And how many hours in a day do you have? Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker studio, streaming live on YouTube.com. So head over to YouTube.com. They had a good quarter for Google, so that was some good numbers there. And you can check us out there. Down market, red on the screen. I mean, we actually had like one whole day of gains over the last week or so, but we're back down to some red on the screen. I'm going to blame our Alex Semenova. She covers all the markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker studio. Alex, what are you looking at?
Hey guys, great to be here with you. So all eyes are on earnings from some of the Magnificent Seven this week. What's been really interesting is we've kind of seen big tech move in lockstep, but that's changing at least temporarily after earnings from Alphabet and Microsoft. It's a tale of two big tech heavyweights. Alphabet shares are down nearly 9% after the company's Google Cloud unit reported a smaller than expected profit. Alphabet President Ruth Porat said in an interview yesterday that its unit sales had been affected by some consumers' cost cutting. Analysts flagged that weakness in its cloud computing business as a key concern, given how important this market is to the company's future. Investors are, of course, looking at the cloud unit to take the lead on growth as Google's search engine business matures. Google has long trailed Amazon and Microsoft in the market for cloud computing. Analysts at Baird said that the cloud results are consistent with the view that generative AI workloads are taking time to move the needle. And then this was the complete opposite of what we saw from Microsoft, which also reported results after the close on Tuesday. They beat expectations, and analysts there specifically singled out the strength in the company's cloud business. So totally different stories here.
So, I mean, I kind of view I thought the cloud numbers were good. I mean, growing 20+% on the cloud here, and it seems like the cloud is just such a monstrous, and AI is such a monstrous spend that there's room for a lot of players to do well. But I guess it's just kind of a little bit of a market share game here. But I think the question I have from Mandeep Singh from Bloomberg Intelligence just earlier is, how much does AI tech spend take from just other tech spend? And he explained this concept of optimization, that in fact that is happening, and so you got to that it is taking from some other IT.
What,
budgets.
meaning people are
taking
a company, say you have, I don't know, $1 billion a year in revenue, and you've got certain amount of money that you can spend on tech, and you're blowing it all on ChatGPT,
right? And you're taking away from some other budgets like IT, for example. So that is happening, but so it's just a question of who the winners are. But I don't know. I thought it was a pretty good number. And plus, Google's had a ripping year on the stock market anyway, up 50%. All right, anything else out there that we're looking at?
Yeah, another tech name. We have shares of Snap moving higher today. The social media platform.
Is that still a thing?
Not my age group. I think people a little bit younger than me are still using it.
People get younger than you?
How much younger can we
Thank
get?
you. I'm flattered. I haven't used Snap in years now. I mean,
Really?
I forget that the platform even exists.
Wow.
I passed that one. I
You-
was too old when it started.
You didn't miss out, Matt.
I never understood. I wish Bloomberg messages would disappear, after like 10 seconds. Self-destruct, leaving no record. I feel like the SEC would have an issue with that.
Yeah, I think our compliance would have an issue with that.
Well, investors are pretty happy about it. They returned to revenue growth in the third quarter after 2 periods of decline. Some measures that they've been taking to improve their digital ad business are finally starting to pay off. They saw sales increase about 5% to $1.2 billion last quarter. Analysts actually expected a revenue decline of 2%. CEO Evan Spiegel said that the company is focused on improving its advertising platform to drive a higher return on investment for its ad partners.
All right, so what do we got coming up earnings-wise? We got Apple, we got Amazon. What's coming up? We got something after close today, right?
Busy docket. I have to take another look.
All right, we'll take another look. We got some tech names.
EVTS Go.
Yeah, EVTS Go, looking at it, yeah. So we got a lot of names coming up here to get through on these earnings here. So we'll keep on top of that, of course.
IBM, Big Blue.
Yeah.
Comes out after the bell.
Oh, nice.
I'll be looking at O'Reilly Automotive.
Oh, that's right.
Today.
Auto parts.
Yeah, it's an auto parts and repair. So if cars are getting too expensive, maybe you fix up the old one.
Yeah.
You had that situation.
I had that situation, and I made the
choice to ditch it and buy a new one. But a lot of people don't, you know. So it'll be interesting to see what they come out with. You got Baker Hughes after the bell today. You've got Norfolk. Norfolk Southern came out and missed, but barely.
Yeah, I don't know. I mean, it's
Whirlpool.
Yep. I mean, Amazon, they are tomorrow after the close. So that's a big one. All right, very good. Alex Semenova, thanks so much for joining us here, giving us the latest on these markets. Again, the S&P 500 off of about 1% here today, so no bueno.
Massive earnings, it should be said also. Just a reminder that I think it's like 40% of the S&P 500 reports this week.
Yep. Yeah. Yep, absolutely. And also a big week for economic data. You type in ECO and you see we got some GDP data. We've got some PCE and deflator data. That's inflation for the kids at home. We got jobless claims. So a lot coming up for the remainder of this week, and a lot of, I think, something for the Fed to chew on. And
PCE.
Also, yeah, exactly. Good
That's
stuff.
what they care about. But, I mean, man, new home sales.
Yep.
Is the conundrum for the day, right? Let's bring in Anna Wong,
sure.
Bloomberg chief U.S. economist, to talk about what's going on here. Anna, we saw a huge surprise, at least it looks like it to me, from the percentage numbers, right? Month over month, new home sales were up 12.3%, and we were only looking for a gain of 0.7%. What does it mean?
Yeah, I think it means that, you know, we have been seeing that a lot of people are priced out of existing home sales, and they're driven into the new home sales market, for partly because the inventory is very low in in existing homes. On top of that, a lot of the pipelines of supply and housing is coming from new home sales, especially multifamily units. And in fact, the supply of multifamily units in the next couple of months to a year looks to be very, very strong. So, I mean, just keep in mind that new home sales is just a very small percentage of the total housing sector. In terms of what's driving GDP, and we're going to get a very strong Q3 GDP number tomorrow. In terms of thinking how that might look in the next quarter or a couple quarters down the line, it is really existing home sales that is more important, and that is not looking good at all.
So what is your take right here, Anna, and that of Bloomberg Economics about this U.S. economy, where we're going over the next several quarters? Because, I don't know, just my read of the eco screen, it seems like we're in pretty good shape.
Yeah, I think, like, Paul, the economics data out there is super mixed, and it's very challenging to read. It's the new home sales versus existing home sales. That contrast is very similar to, you know, the GDP we're going to get tomorrow for the third quarter is going to be around 5%. And anybody who looked at that number would be like, the U.S. is in a boom. The U.S. economy is totally resilient to the 5.5% rate hikes that we had seen. But that's not our take. Our take is that a lot of the strength we are going to see in tomorrow's Q3 GDP number is driven by temporary factors. So 3 things alone account for almost the entire strength in the third quarter. Number 1, consumption. Number 2, net exports. And number 3, inventories. And
what was the second one? I'm sorry.
The second is net exports. Net exports. So
Exports.
Export
okay.
minus imports. Okay. Yeah, that actually contributed 1 percentage point.
But that's awesome, right? I mean, these things all sound like your basic blocking and tackling, right? Consumption, the consumer, the stuff we make that we sell to other countries. So our domestic economy is great. Our export economy is great. I mean, what's bad?
It's not that. That's what it looks on the surface. So, the net export starts with that. It's because imports is contracting. When an economy is actually strong, imports actually increase, not decline. On top of that, the inventory swing positive contribution to GDP is consistent with the decline in imports. It basically tells you that firms are cautious about adding more to inventory because their inventory is rising due to tepid demand, and firms are still in the midst of destocking inventory. So this buildup in inventory is not due to anticipation of higher demand. On the consumption side, we have seen that in this Friday's PCE data, we're going to get both income and also spending data. That will show that consumption has exceeded income growth for the 4th consecutive month, which means that this resilient consumption that we are seeing is funded on either borrowing or drawing down on savings, which by definition is not sustainable.
That's
right?
so American. I mean, that's how we work,
That's
isn't it?
very
Is that
American,
different than
Exactly.
other boom times?
Exactly.
I wonder, Anna, if you look at the, I think the export-import thing is interesting because over the past couple of years, we've been talking almost on a daily basis about reshoring, friendshoring, bringing back manufacturing to this country. Is any of that responsible for what we're seeing in the numbers? I mean, obviously, I'm not going to be importing a car from Germany if I buy one made in Detroit.
Not at all, because in fact, the reshoring, nearshoring should be channeling into investment data. Because first, you need construction, you need factories before you can start. So in a couple of years, you may. And I think the reshoring story would show up in structures, investment, like the CHIPS Act and all that. But even that is not saving the economy right now. If you look at the construction, manufacturing, that had been surging in the first half, right? And that was a big tailwind to growth. And for the past year, I always thought that if our recession call was wrong, it would be because of this Bidenomics industrial policy supporting nearshoring, all that would generate this investment boom. But
also,
even
speaking
there,
of spending more than you make, I mean, that's a fantastic way to look at what the federal government's been doing. But it doesn't look like they're going to stop. If 5% in the Q3 is a head fake, Anna, what's your Q4 GDP expectation?
Our Q4 GDP expectation is it will dip slightly below 0, but we won't be surprised if it's a 0 or it will be a range between negative 0.3 to positive 0.3. It would be very, very tepid. And we do expect a recession to begin around the turn of the year.
See, I took the recession off my plate like 3 or 4 months ago. Now, of course, Anna, no one cares about my opinion. They care about your opinion. So you guys
just keep pushing it back. They just keep pushing it back, right?
You can do that if you're an economist.
It was going to 100% chance this year, and then it's coming in the second half, and then now Q4, now 2024. Is that what you're saying?
No, I would push back on that because I don't think we have pushed back that. I mean, a year ago when we started making the recession call, we said it would be in the second half of 2024. It's always the model fluctuates between 2024 Q1 last year to July, as early as July this year, but it always has been in the second half of this year. We are still calling it for before the end of the year.
Okay, very good. Anna Wong, thanks so much for joining us. As always, appreciate getting a few minutes of your time. Anna Wong, Chief U.S. Economist for Bloomberg Economics. I mean, I think I have to see it in some of the employment numbers, and we haven't seen that yet. And I don't know, if employers are hoarding employees. I've never heard of that in my lifetime, hoarding employees.
Well,
but I guess
seems,
it's a thing.
And that's what we hear from a lot of the guests that we talk to, right?
I know.
Employers are hoarding employees. And I also hear from a lot of employers that they're waiting for a little bit of attrition to happen. So they don't want to necessarily fire people, but they want people to quit, and that isn't happening.
All I can tell you is all of the Sweeney offspring are gainfully employed. So that tells me we have a robust labor market out there. I mean, if we get those folks jobs.
If your kids can get jobs,
exactly.
then,
How good
then
is that?
anyone can.
Yeah, actually, good jobs. I'm like, they're doing great out there. I'm very proud of them. S&P 500, we're off a solid 1%. The NASDAQ didn't like some of those tech results from last night. That's off about 1.5%. Yields pushing out again. 10-year Treasury up 9 basis points, 4.91%. I'm calling out Bitcoin, kids. It's up more than 2% again today, 34,400 on Bitcoin. This is Bloomberg. Let's get some company news with Lisa Mateo.
Thanks, Paul. Shares of Alphabet are falling after its cloud unit reported a smaller than expected profit, despite a beat across the board on all other metrics. Bloomberg's Ed Ludlow, he spoke with the CFO of the company, who talked about customers cutting back on their cloud spend.
And when I asked Ruth Porat if they were able to add new customers in the quarter because of generative AI, she describes what they call a backlog across all AI applications, but no data that would kind of support forward-looking growth, specifically for the cloud. We saw resilience and stabilization in search for Google and also ads for YouTube, but it basically isn't enough.
Now, Alphabet shares are down more than 8%. On the flip side, Microsoft reported strong sales, boosted by recovering cloud computing growth. Bloomberg's Isabel Lee says the company was also boosted by its investments into AI.
It poured around $13 billion into the firm behind ChatGPT. And this makes one wonder, did investors really underestimate the cloud story amid all this AI frenzy? Amazon is still the leader in this area, though, and it reports on Thursday. But for Microsoft revenue in the first fiscal quarter rose 13%. So this is the most in 6 quarters, and it topped all analyst expectations.
Microsoft shares right now up about 3.5%. And big tech earnings will continue after the markets close today with IBM and Meta. Now, IBM is expected to report its biggest percentage revenue growth in a year, but investors worry that tight corporate budgets will hurt sales. Now, Meta investors, they're watching for benefits from the firm's big bets on AI and a potential rebound in digital ads. Right now, IBM down a fraction, Meta down about 1%. Those are the company stories we're following. I'm Lisa Mateo.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. We check the markets all day long here on Bloomberg. Stocks are moving lower, dragged down in large part by Google parent Alphabet. Disappointing cloud figures have Alphabet on track for their biggest decline in a year. We're down more than 8% right now. The broader market is lower as well. The S&P 500's down 1%. The Dow Jones Industrial Average is down 0.4%. The NASDAQ, tech-heavy, lower by 1.4%. 10-year Treasury is down 19/30 seconds. The yield at 4.90%. The 2-year yield 5.08%. NYMEX crude is down 0.6% at $83.27 per barrel. COMEX gold is up about 0.1% at $19.8870 per ounce. The euro trading at 1.0577 against the dollar. The yen 149.92. A little more color on Apple's price increases. It's raising the rates on TV Plus, arcade gaming, and News Plus subscription services. TV Plus is going up from $6.99 to $9.99 per month, while arcade is rising from $4.99 to $6.99. Apple News will now cost you $12.99. That's up from $9.99 per month. Apple shares are lower by almost 1%. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com. That's the internet, Matt, and search Bloomberg Radio. All right, we still have the auto workers on strike. It seems like the strike is expanding in scope. Doesn't seem any closer to a solution here. Question is, what does it mean for these companies and their balance sheets? So we got Joel Levington here. He runs all credit research for Bloomberg Intelligence, and his day job, he follows these auto guys and the industrial companies from the credit perspective. So Joel, when I think of the auto companies, I don't think of them with the strongest balance sheets and strongest credit profiles. And if this strike goes on, is it a risk here, or what type of risk is it to their balance sheets and to their credit?
Yeah, Paul, no, it's a great question. And really, the U.S. companies autos have weaker balance sheets to begin with than the European names. It hasn't really been too much of a concern at this point, but as it extends, right, we're already in week 6, it becomes an issue. And really, it becomes an issue because the payables on these companies' balance sheets are huge, in excess of $30 billion, and you don't really have receivables to offset that. So you have this liquidity issue of...
All right, you already lost Matt Miller on that.
Yes,
receivables, payables discussion.
Payables, you're paying your suppliers every 60 days, and as you have no sales, you still have to pay them. On the flip side, remember, they're selling to their dealers, so they get the cash kind of up front. So that cash...
right?
Yeah.
Because when you sell a car to a dealer, you don't get cash for it, right?
Right. Well, it's done through usually done through floor planning.
You're owed.
So, well, essentially you get it very quickly. And so there's a timing mismatch. You get the cash up front, and then you have to pay your supplier. So when there's no more sales, or when sales decline, you don't have the money coming in because you're not selling to the dealer. But on the flip side, you still have to pay your vendors. And so that's where all the cash drain happens. If you recall, during the pandemic, Ford had to issue $8.5 billion worth of debt, which is very high coupon debt, which eventually they called in at a premium on top of that, just to keep their liquidity whole. So, hopefully that's not the situation we're in, but certainly it feels more uncomfortable
Well, when we
every
get
day.
into next year and we look back, I'm sure the strike will be resolved in the next few weeks. Seems like they're done. They just need to strike a little bit longer.
Is that right? Is that kind of the feeling?
That's what I got from your interview with
Yeah.
David Welch this morning,
Yeah.
Which is that Sean Fain has to make a lot of noise. He had huge demands. They're going to get a big pay bump, but obviously not the pensions or the 4-day work week.
I was rooting for the 4-day work week.
Yeah, I thought it would be awesome. 4-hour work week is what I'm for. But when you look back at the second half of 2023, how much of an impact is this going to make on the top line?
Probably not that much. I mean, I think particularly with Stellantis, so like your Hellcat and Dodge and Chrysler, they built inventory in front of this, knowing that there might be a protracted.
They built a lot of Jeep Wranglers, we heard, ahead of this.
I mean, if you go to the Salerno, Dodge
Salerno
Salerno in our town, they certainly have a lot on their lots of Broncos and Rams and Jeeps. So
Wranglers, you mean?
And Wranglers, yes. And so
Broncos are Ford.
No, well they have two.
Oh, I see.
outlets
Okay,
there.
they have two stores.
But yeah, all the autos had lots of inventory on their lots. Knowing that you might have a several week lack of supply coming out.
So wait, just to sidetrack on the Bronco thing, you got a dealership in your town that has a ton of Broncos on the lot?
Yeah, man.
Do you go in there and, are they charging $5,000 or $10,000 over MSRP, or can you actually just buy one?
I think you could just buy one.
Where do you live?
We'll give you that offline.
Summit NJ. Yeah, right at the train station. Walk off the train.
Yeah.
There it is.
So what do you think the union is going to get at the end of all this? It looks to me like they're going to get 23% increase in pay, right? It may be bigger compounded, and but no pensions, right? They're not going to get that back.
No, I think you're totally right, and I think you're probably in the 25% zone is where it kind of works out. I think one of the reasons that you hear people like Dave Walsh, who does a great job in our Detroit office, talk about it being extended is because if you think about from the UAW side of things, they've had a complete decline in volume and customers for decades, right? And they have to kind of turn it around. So if you can pop a 15% increase in salary on day one, that will get other industries and other autos to be on notice that if the UAW's in town, certainly more people could join them, which is really their goal and game to become more profitable.
They're signing
on
up
their
battery
side.
factories now. I'm sure they hope that some Tesla shops will look at the union and say, you know what, let's try it again.
Yeah, and all the non-union shops down south or in the west.
BMW.
BMW, Volkswagen is building a new $2 billion Scout facility. So I'm not sure if anybody's
That's
going
to
to
happen?
But
Is
that's
that
happening.
really going to happen? I saw at the import mechanic in Bronxville, right around the corner from Rosie's, they had an International Scout on their lot, and I thought, man, that is cool, so cool. But
You have no room in your parking garage.
No, I don't.
Anyway.
I don't know. But I feel like, is it really going to happen? Is Volkswagen really going to revive that brand and actually make a mass production product?
They are, although if you look at the products that they've shown online, it looks very, very similar to the Rivian products.
Yeah.
Just with a brand name that nobody remembers.
But is that going to live? Is Rivian going to live?
Rivian, I think, can live. Like they did a convertible bond a couple of months ago, which really gives them some liquidity in time for their next product to come out. But just like all of these EV companies, they're years away from making profit. So it really becomes what's your liquidity and access to the capital markets for more of it, because you're going to need it.
Let me ask one more stupid car question, then I'll yield the floor. The Cybertruck, Elon Musk on the conference call when he was so bummed out and getting kind of philosophical and dark, he said we never should have, launched into this special product, and we should have known that this special edition would have caused us to go back into production hell. He was talking about it as if it were limited, right? Don't they want to challenge F-150, Chevy Silverado, Ram 1500, these, massive volume products with huge margins? Isn't that a market that they want to take a piece of? Or is this just like, if you got one in the 2-year production run, you're lucky and then it's done?
I don't think the Cybertruck is the answer to the F-150 or the Silverado. I think really what they're trying to do there is really work on gigacasting, which is really making these huge casts. And when you can do that, you can really cut down production time really quickly. But I think where Tesla is headed is really towards the Toyota side, not towards making SUV, not necessarily making a lot of money off of a pickup truck, but really on the smaller cars. And I think you'll see that with the Model 2. That's where I think they can get super high volume and get it out to the largest amount of consumers, right? Their business has always been about the retail person, not the consumer, not the commercial application like you'd see in an F-150. So I think that's really where they're headed. But having that ability to cast in great scale at a short period of time, that can give them a competitive advantage even against an amazing manufacturer like Toyota.
GE. GE's back, baby, after like a 10 or 20 year hiatus in terms of being a stock and a company that seems to be headed in the right direction.
It cost me my hairline, but they are back in action and doing really well. And I think there's potential rating upgrades, which should enhance views of their bonds. They will be separating their energy business in the second quarter of next year, or probably at the end of the first quarter. And that really will keep it as a pure aerospace company. And by all metrics, they should be back into the A category for the first time in 5 years. And their bonds do not reflect that. And so that's been a huge winner this year, both in the stock market and in the bond market.
Yeah.
And I think that can continue into next year.
I'm just looking at the FA function for GE. In year-end 2019, he had $94 billion of debt. Now they've got like $24 billion.
Yeah, it's amazing if you think about what they did with the finance company. At one point, I think at their peak, they had about $500 billion worth of debt outstanding, and that's been whittled down to the 20s. About $20 billion today from almost $500 billion.
So GE is back. It's just a shadow of itself, though, in terms of size.
They have skinny down to the core business of aerospace, and they are really a strong player in that business with a lot of aftermarket products and a 20% margin with very little capital intensity. So that can be a huge home run for investors.
All right, and who's the CEO? We like this guy, Larry Culp.
Larry Culp.
Yeah,
he was great at Danaher and has done a tremendous job at GE.
See, it can be done. So Jack Welch, Jeff Immelt, no.
Joel Levington.
Yeah.
We got to get this guy in the studio for like a half hour.
I know. He's right. He can talk about
I have
anything.
a million questions. Let's go to break so I can ask him some more questions.
All right, very good. Joe Levington, he's the Director of Research at Bloomberg Intelligence. We're going to have more coming up. But right now, let's head down to Washington, D.C. Amy Morris has got World and National News.
All right, thank you, Paul. The political debate over the war between Israel and Hamas has moved to the United Nations. UN Secretary General Antonio Guterres says Israel is violating humanitarian law. Bloomberg's Oliver Crook is in Tel Aviv.
This was the part that the Israelis took issue with. It is important to also recognize that the attacks did not happen in a vacuum. He also said that the Palestinians have been subject to 56 years of suffocating occupation.
Bloomberg's Oliver Crook in Tel Aviv reports Israel accused the UN Secretary General of being, quote, completely disconnected from the reality in our region. There have been a couple of key developments in two of the legal cases against former President Donald Trump. Bloomberg News has learned Mark Meadows, the former White House chief of staff, has been granted immunity in special counsel Jack Smith's federal election interference probe. Meadows told a grand jury he repeatedly told the former president